Good afternoon, Fools, to another episode here of Fool24. This is going to be the first hour of us streaming on YouTube, but if you are a Fool member, we've been streaming for, I believe, 4 hours already, or this will be the 4th hour. Today, my name is Najarro, and today I am joined by Neil. Good morning, good afternoon, Neil. How's it going?
Good afternoon, Jose. How are you?
Pretty good, pretty excited. I mean, one more day till the market opens, and one more day for the madness to start all over again. So for those fools that are not familiar, and for those on YouTube stream, if you have any questions, feel free to go to slido.com and enter code Fool24. Neil and I will be here for, I think we're both in for 2 hours, right, Neil? You'll have us for 2 hours. We'll be discussing pretty much the semiconductor, the tech space, Max 7. Neil's also really knowledgeable in the fintech space. So feel free to ask any questions about those industries. And if we don't follow those industries, feel free to still leave them on the Slido, as maybe Neil and I can do some live research on them, or there's going to be fools later on that are going to cover the episodes or Fool24, and we'll be able to answer different topics. Like always, this is not personalized financial advice. Neil and I would just be sharing our thoughts and how we handle our own portfolio. So Neil, yesterday, I think we started this episode kind of explaining maybe some of the things that we were excited for this upcoming week. Not much changes within the 24 hours, but maybe some viewers weren't here for yesterday's hour. What are you excited, Neil, for the upcoming week here as we're getting ready for the stock market to be open?
Yeah, so first up, thank you for putting on some green today. Maybe that will push the markets a bit higher tomorrow. But yeah, in the coming days, now I did not forget GTC event, of course, keynote from Jensen. So lots of interesting information will be shared, I'm sure, about some AI applications, more developments in the AI world. So that's on Tuesday. And then we have, well, for me, I have a couple of companies that I'm following that will still report earnings. So on Thursday, I think all of them report on Thursday. We've got Pinduoduo from China. I hold Alibaba, so Pinduoduo being a competitor. Always wanted to hear what they have to say. With China, their economy, I think they're in a deflation type of environment. There might be some stimulus coming. So it remains to be seen what happens with that. Thursday, after the market close, we have Micron and Nike. I think we both own Micron. So that's going to be an interesting one, especially for the whole semiconductor industry. And then Nike, just because it's Nike, the new CEO, let's see how the recovery play is doing. And then on Friday, we actually have NEO and Carnival Cruises. So those are the ones I'd say I'd watch for next week.
Yeah, Neil. And I mean, for me, the big thing is going to be that GTC event, where I'm probably going to be, even though the keynote is on Tuesday, throughout the week, there's going to be a lot of different conferences and presentations that I will kind of be reading or watching on their live stream throughout the week. But Neil, one quick correction: I do not own Micron, but I do believe there is kind of growth opportunities in that one, in the memory space. And it's one that, while I don't own it, I follow very closely, Neil, as we've talked about in the past, right? Micron, the memory technology, is pretty much used in every type of tech and electronic we have in the world right now, being automotive, smartwatches, tablets, computers, TVs, the list goes on and on.
Yeah, no, I agree. I think I've seen also a couple of reports for Micron talking about memory prices. NAND wafer prices keep climbing with more hikes ahead. So could be good from a margin perspective for a company like Micron, like SK Hynix. Now remains to be seen what happens with their customers, because if they're hiking prices, are their customers going to take the margin hit, or are they going to make their products more expensive? Remains to be seen. But I think we discussed and we said that for 2025, the prices are already locked in. I think it's only for 2026 and onwards. We also talked a little bit about the anticipation of the upcoming quarter. Guidance was a miss of $1 billion. Market was expecting $8.9 billion in revenue. they guided for $7.9 billion. Then a couple of weeks ago, there was a conference and they said they're also going to take 100 basis points margin hit or something like that. So we already know what we should expect. So I think all of the expectations from the market are probably going to be about guidance for the upcoming quarters.
Yeah, I agree, Neil. I think right now in the overall, just in the kind of I think the whole market right now, guidance is really a very crucial point. Normally, it's always this, right, Neil? But I feel like lately, with a lot of the uncertainties with things like tariffs and other kind of kind of global tensions, I feel like in the past week or so, we've seen maybe certain companies be a little bit more hesitant on giving a stronger guidance, or they kind of mentioned they want to be a little bit more conservative during the uncertainties right now. And I think this one is going to be one of the first few, or it's going to be the ending of kind of like a semiconductor market that focuses a lot on consumer tech. So I'm curious more to see how they see that guidance, how they see any kind of tariffs potential impacting the overall business. So I'm going to guess the Q&A session here is going to be filled with a lot of those questions focusing on tariffs, as they are very, very heavily dependent in the consumer space.
Yeah. Plus, I mean, I think they'll have the advantage of a GTC event happening in the same week. So maybe there's a lot of attention that's going to go to that. And hopefully some good announcements are going to be made. And that might maybe move the market to the upside, might push these big tech companies that are spending tens of billions of dollars in capex this year, and might push them higher because it makes sense. Because if, let's say, during that GTC event we have amazing announcements, whether it's healthcare, robotics, gene sequencing, you name it, lots of AI applications, if it makes sense to invest that much, because eventually we're going to reach a point where XYZ gets built, where we're going to get these types of results, then that might be the sentiment change that the market needs at the moment. But on the flip side, you probably still have some macro that will impact the stock and the uncertainties.
And Neil, I know you follow kind of the fintech space a lot. And we've seen a few companies that before kind of this whole AI craze really started, we started to see kind of AI taking place in things like maybe help selecting if a person is a good choice for things like loans, and also kind of with the data be able to select the great type of person for not even loans, just whatever type of financial product that they might have. Is there any major change you're seeing with AI in the fintech industry, or do you feel like maybe for companies or some of the big players, I know you're a big investor of like PayPal, like companies like that, you like the direction that they're going with AI, or do you think it's still nothing that's revolutionary in that industry?
Yeah, so like you said, with loans, I think there are a couple of companies that do that. But I think with loans, you're also focused heavily on your FICO score and stuff like that. Maybe the buy now, pay later players can use AI to make sure that they're not really giving out these options to users that will be in the high delinquency group, right? Because I mean, if that's the business model, that's not going to work. But with PayPal specifically, yeah, they've been talking a bit more about AI, whether it's for fraud prevention, detection, and all of that, making sure that payments are made safely, quickly. And then inside the company, of course, as they move towards a more commerce player as well, commerce platform where you want to connect the both sides of the ecosystem, the merchants and the consumer side of things, how you make sure that you match those through the use of AI, through the use of other technologies as well. Advertising, that plays a part, right? We've seen that with Google, we've seen that with Meta, better targeting, higher return on investment. So most of them are using it, probably using the term a lot more today than they did a couple of years ago. That's not to say that a couple of years ago they didn't use these types of technologies, but today, since everybody wants to hear that term, I guess you're going to hear that term more and more. But yeah, you use it, fraud prevention, safety, good matchmaking for merchants, advertisers, consumers, and stuff like that. So yeah, I see that with PayPal. They've talked a little bit about that during the investor day, during the earnings calls. SoFi, same thing. I think there is also a question about SoFi from Paul 22 hours ago, so we can touch on that as well. So what's your take on SoFi? I think throughout 2024, the stock has struggled up until the last couple of months of the year. And I kept saying the same thing. This is a good company, broken stock, because the company kept on beating each and every quarter, beats across the board. Company continues to grow and grow, even though the lending side of the business with the loan moratorium that was in the United States, it basically made the business operate with one or even two hands tied behind their back. And still they came out of it as a stronger company. They became a profitable company, 5 consecutive quarters, a GAAP net income. So they're doing very well. Yes, the stock today is higher than it was a year ago, but a couple of weeks ago, the stock was also higher than where it is right now. So to me, it's still the same thing. Very good company, good management. Sometimes, yes, broken stock. And then you're saying, okay, but it's a bank. I think PayPal is not a bank, shouldn't be trading at bank multiples because one, SoFi in my eyes is not a bank. It has a bank, it's not a bank. Plus it's growing much, much quicker than any bank out there. Might not be as profitable as the other banks at the moment, but in the future, I think we could reach those levels. And if we want to be, because they've been saying that Galileo, which is the tech platform, which is basically where the likes of Robinhood use the Galileo platform to operate their business, to make some, it's like Marqeta for credit cards, debit cards, and stuff like that. You can build on top of it, be a bit more like a neobank, for example. That should have been the margin expansion that people wanted, or the multiple expansion as well. So far, Galileo tech platform did not really grow that fast or as fast as expected. They did say that it's more macro related. So the whole banking industry, right, a year or so ago got a shock. Bad timing, basically. They say that 2026, that's when things start to reaccelerate. But in the meantime, you've got under the financial services segment, so you've got the lending segment, tech platform, financial services one. So under the financial services one, you have a product that really came out of nowhere. That's the loan platform business. Basically, high margin, fee-based revenue, lower risk on the balance sheet. And that one is starting to grow much, much quicker and is already today extremely profitable for the business. So I think while the tech platform has been a disappointment, I think suddenly the rise of the loan platform business should make up for that and then some. I'm very bullish on SoFi. I think they're going to do very well in the future, and that's why it's in my portfolio.
And Neil, one thing you mentioned there is like companies like SoFi and PayPal shouldn't trade at multiples, so be kind of like in the valuation of other banks. Because even though they have a bank, it doesn't mean they're necessarily that's their core products. And also they are growing a bit faster. Just to pick your brain, Neil, how would you like as an investor in the fintech space, and I know you follow kind of the tech market, what are some of like the different metrics you might be looking at, or some of the maybe not even valuation metrics, but just financial metrics from the actual business that you are looking at to help you maybe say, okay, maybe this one is trading at lower valuations than I believe it can be in the future?
Yeah, so PayPal, SoFi, a bit different. PayPal, I mean, even if you look at the forward PE, it's still very cheap. Yes, it's not growing as fast as previously expected, especially not revenue, although EPS is growing much quicker than that. And they say that in the future, they could be growing, I think, EPS over 20%, if I remember correctly from the investor day. And I think if that's possible, then the PE shouldn't be less than 20. It should be much more than that. So for PayPal, I'm looking right now, specifically right now. Yes, you're looking at a 4 PE. You're looking at price to free cash flow, because I think that's an important metric, and they generate a lot of free cash flow, buy back a lot of shares. But you're also looking at take rate of the business itself that has come down for the majority of the industry. Looking at transaction margin dollars that did start to increase last year, which was already quite good. You want to look at the business. Is the business really rebounding and growing? If so, then you're looking at, okay, why is revenue not growing double digits? Why is EPS growing double digits, high double digits, and why is a revenue not? And then you see, okay, they rather become more profitable at the moment, make sure that the business, the margins make sense. And once that's done, they're back to revenue growth. And you're like, okay, fine. So far, short-term revenue decelerate because Braintree, which is basically what you don't see, because usually with PayPal, what you see is the checkout with PayPal. Braintree is what happens behind it. So it can be on a website where you don't even see PayPal, but Braintree is the one that powers it, like in Stripe or an Adyen, for example. That used to grow extremely quickly, but they took a margin hit. It's a very, very low margin business. And now it's going to be the opposite. Now they're going to price it to value. So they said, look, we're going to decelerate revenue growth for Braintree, but make sure that it adds to our margin, make sure that it adds to our bottom line. And as our customers, our merchants realize that, okay, we're pricing it to value, we're willing to pay the price, and then we're going to see growth reaccelerate. So that's PayPal with SoFi. Since SoFi, they do loans and all of that, so looking at free cash flow doesn't always make any sense. But with SoFi specifically, I'm looking at EPS growth. If that's still on track for 2026, they set out their targets of, I think it was 67, 69 cents at the midpoint. This year, EPS is taking a small hit, well, compared to the expectations, because they're willing to invest more in the business, but that 2026 target did not change. So I'm still fine with that. And they said that they can even grow EPS afterwards between 20 to 25%. So as long as that doesn't change, I don't mind paying a high PE, all things considered, for a name like SoFi, because it is growing as quickly as a tech company. It might not have the margins of a tech company, but an EPS that still grows 20+% year after year is quite something. And then eventually as the business matures, then you go and probably look at the usual pricing metrics. But right now, especially those names, I'm focused on some particular business metrics, and then of course the price that you want to pay for it.
Thank you for that, Neo. And we do have a pretty interesting, we have a few questions that have come out in the past few minutes. I want to take the first one, but Ed, there's also a question about Salesforce that I think I can take a closer look after this one. But Kent, 3 minutes ago, some previous discussions indicated that the second half of 2025 would be better for AMD. What data info are you looking at, and timing June, July, and or August? I think we can both say that the biggest data and information is just pretty much coming from the company itself, management in specific. During the most recent earnings, management mentioned that the MI350 series, which is kind of their next generation of AI GPUs, is expected to come out closer to the mid 2025, opposed to originally coming out in late 2025. And the reason they're doing that is because the management mentioned that they're seeing a lot better engagement on the MI350 than previously expected, and they're getting kind of a lot of great results. If I'm gonna be honest, I don't think a company's gonna pull forward a product just because of great engagement. I think they're really close to maybe just almost finalizing the deals on some of these GPUs. So I do think they're AI GPU market can grow at some nice healthy levels versus last year, and mainly driven by the MI350. So first, Ken, it was the AI GPU market. They're pulling up ahead of schedule by a few months. Unfortunately, we didn't get the data about it. And with the actual timing on the stock price, it's very hard to tell right now, because if the company next quarter tells us a little bit more about guidance, maybe the stock price can go up a lot higher because of that guidance results. If they don't tell us anything about guidance, maybe we see it when we start to see those products ship out. So I think it's also going to depend on kind of management's information sharing in the upcoming quarters that can kind of cause maybe some movements. But I think Neil and I also, when we talk about kind of the bullish sentiment for AMD, is more about the bullish sentiment of the business. And like I think Neil mentioned perfectly with SoFi, where the business is doing good and it's growing, but sometimes the stock price might take a little bit longer for it to react to it. But I think as long-term investors, we definitely have a higher success that the stock price eventually meets the fundamentals, even if it might lag on kind of absorbing the data. I think the second info, Neil, also came from earnings call, but recently on March 3rd, at a Morgan Stanley Media and Telecommunication Conference, the CFO of AMD was there, and the CFO, I believe her name is Jean. Jean talked a little bit about kind of that they are seeing recoveries in a lot of the other industries outside of the AI space. So they're expecting to see slow but steady recovery in the gaming market, in the embedded market, and it's going to continue to progress slowly throughout 2025. So you would expect the second half of 2025 to see even bigger of that growth opportunity. Outside of that, we have heard that AMD's management is very confident that one, they gained a nice amount of market share. They gained about 5 to 6 points of server share in the CPU side last year, and they are confident that they're going to continue to gain gains in 2025, progressing throughout the year. Very similar to kind of their client business. The client business and the server business are pretty much expected throughout the whole year, but now coming into the second half, you kind of have that strength of those two markets. You have the strength of the MI350 coming up ahead of schedule, and then you have the embedded and the gaming market also picking back up. That in theory, you should see a very strong second half for AMD in forms of business. Now, the real question is, will the stock price follow that before we see it, when we see it, or after we see it? I think that's always the question here when investing. Any thoughts there, Neil? Anything I might have missed there?
No, I think you were spot on. I think there is a perfect storm brewing for AMD, the business. Whether or not the market wants to reward the stock, that's another question. I think, like I said, my prediction is that we're going to get AI revenue guidance in the back half of this year, so after Q2, just because they're going to have better visibility on what already has happened the last 6 months, plus what could happen in the next 6 months. So maybe they already know what's going to happen in the 3 months from the earnings reports. And I think that's when the stock will start to move, because analysts are expecting 65% year-over-year growth for AI revenue. Some analysts expected it to double, so to go from $5 to $10 billion. Some 8 billion, some 9. Okay, I think if they can reach 10, that would be great. A minimum would be probably $8 billion for the year. So you've got that, but you also have, like you said, the gaming side of the business, the embedded side of the business that should start to be tailwinds for the business and not headwinds. And I think as we now see forward PE very low for a company like that, it's becoming more profitable, right? Free cash flow is becoming bigger and bigger. I mean, yeah, second half is probably when we're going to see the business start to really show its strength. And then it's up to the stock market to decide whether or not it wants to reward that business or not. But eventually it will.
And one thing, Neil, is I feel like sometimes we see in a lot of these industries, like the gaming, the PC inventory, and the embedded market kind of had an over inventory issue that was happening. And even though maybe that over inventory issue doesn't show much growth quarter over quarter, I do believe even if the growth is minimal, the margins improve dramatically, because during an over inventory correction, right, they're trying to sell all these products at lower pricing, gross margins take a bigger hit. But once that inventory issue is kind of fixed, and they're saying it's getting fixed, even if revenue growth is only increasing a small amount, you're no longer kind of having that pricing war to how you had it before. So even if revenue only increases small amount in some of these industries, free cash flow can increase dramatically, earnings per share can increase dramatically, overall gross margins can increase dramatically, as that pricing pressure is not there from inventory issues. Now it's just, hey, look, we'll pay regular pricing, but maybe we won't buy as much right now because we're still worried. And that kind of takes over time. And then eventually you start to see the opposite, where you start to sell a lot and you're able to do pricing power a lot higher, because you kind of have the higher demand, so you're able to command some of that pricing strength. So I think that's another thing that's exciting, is while we might not see maybe in those industries strong revenue growth, I think we will see strong bottom line growth for sure.
Yeah, and I'm just looking free cash flow for fiscal 24 was $2.4 billion. That increased 114.5%. And that's expected to grow to $6.7 billion in fiscal 25, then to $7.9 billion in fiscal 26, and then to $11.32 billion in fiscal 27. So huge growth for free cash flow, which will allow the company to either invest even more or buy back more shares.
And I just want to give a quick shout out here to Tax Accountant about 7 minutes ago. Hi, Jose. And this is regarding to the questions of some of the metrics in the fintech space. Tax Accountant, hi, Jose. In addition to Neo's response for SoFi metrics, I'm also watching customer growth. And my apologies, Tax Accountant, I'm not too familiar with Neo. Maybe you can help me out with CAC improvements. And their long-term goal is to be a top 10. I'm guessing FI is financial industry or institution. Yes. I'm very much behind in this fintech space. So appreciate that, Neo, and appreciate that, Tax Accounting.
That's the goal, to be a top 10 financial institution. So definitely if they're tracking to be that's fine with me. And I agree with him. Customer growth and CAC is basically the amount that you have to spend to acquire, cost to acquire a customer. That's the CAC number, which I'm also tracking each and every quarter. So basically, you can take the sales and marketing cost, and then you take the amount of members that you've attracted in a specific quarter. You divide that number, and you get that, and you see how much they have to spend to get one specific customer. And then, of course, it's up to them to start cross-selling services, and then the eventual cost to acquire or cost to serve is also a metric you can look at. Eventually, has to be very low, and it's already quite low compared to some.
Thank you for that, Neil. Now, so Tax Accountant, appreciate it. Correct. CAC, customer acquisition cost, and FI, financial institution. So this is why I love doing these shows, Neil. There's obviously industries I don't follow, and I get to learn here. So appreciate both Neo and Tax Accountant and any fools here that help us also learn throughout the process. Now we have a question here from Neil from Ed about 5 minutes ago. So we've talked that Nvidia has their GTC conference this week. Do semiconductor stocks get a boost this week? I'm going to say, Neil, the market, if they do get a boost, it's most likely going to be what I would consider a noise and just kind of short-term hype. I think if they announce maybe some interesting partnerships, let's say they somehow Micron was able to double capacity, and they announced that during GTC, and Nvidia mentions, hey, look, we're going to buy this extra double capacity. Now that's something that can definitely be more of like a long-term investing thesis changing, in my opinion. I don't think something like that is going to happen. Usually we kind of see kind of like these very small partnerships here and there that can create maybe short-term hype. I think companies like SoundHound AI are going to be at this event. So many people are going to be saying like, hey, look, SoundHound AI is at this event. You might see my short-term price movement. I think in the semiconductor industry, you're going to have to really follow to see if those movements are, like I mentioned, more for the long-term thing or just hype with the event. But I do believe this week with NVIDIA's conference, we will get some form of hype in the semiconductor industry. But it's going to be hype that can fade pretty quickly. So I really wouldn't pay too much attention to it. Any thoughts there, Neil?
Yeah, I would be surprised if we get like a huge partnership announcement that we didn't know of during GTC event, because eventually it is an event for developers, right, and less for the financial folks. Although we do get announcements, right? But it's more technical stuff like, oh, this cloud player, that cloud player. I would be surprised if suddenly Jensen said, oh, actually we're going to build chips here in the United States with Intel, and it's like, puff. But I highly doubt that's going to be said in during GTC.
Yeah, and sometimes like the real changes happen when in the technical side that it takes a little bit longer for the stock markets to react. Like one thing that really happened between when they announced the Blackwell platform is that they were getting rid of a lot of kind of optic solutions and going more with AEC, which is active electric cables, to do a lot of the connection. So we did see kind of in the past few months, and after that event, we kind of saw maybe some of those fiber optics and optics companies maybe see a bit of a decline for some time. And we saw those other stocks that deal with active electric cables or AECs to kind of see a nice rise up in price. So if we kind of see any form of long-term partnerships, I think we have to understand what are some of the changes that might come up with, because we will be hearing about the Grace Blackwell 300, the GB300, which is the Blackwell Ultra platform. And it's going to be interesting because I'm expecting some, but not much Ruben, because Grace Blackwell is still for this year. I would expect we hear more from Ruben during next GTC, but I'm going to guess we are still going to get at least some tease and maybe some high level approach of the Ruben GPU platform as well. So if there are any changes with, hey, look, we're no longer going with AECs and we're going with some new technology, that would be certain that market might see some reaction. So, there's going to be a lot of noise. Some of that noise is going to be warranted. Some of that noise is just going to be short-term hype. And it's going to be very hard to distinguish unless we research and understand which one is real.
Yeah, agreed. You want to touch on that Salesforce question from Ed?
Oh, yeah. So Ed talked 26 minutes ago. Is Salesforce one of those companies that have little upside, but much risk and probably not worth holding? Salesforce, I mean, Ed, I think this is a question that all depends on what markets you are excited about. With every investor, you're probably going to get a different answer. Let me kind of share my screen really quick and kind of look at some of the metrics that I saw for Salesforce. So, I mean, if we look at here at PE ratio forward for this company is 25 and PE ratio forward 1 year is 22. It doesn't seem like crazily overvalued in my opinion. So I feel like from my thesis, there's not much risk to it. Obviously, every stock has a risk, and it doesn't mean that it's going to perform great, or it doesn't mean it's going to do horrible. Current growth estimates for this fiscal year, it doesn't seem like it's a major grower. It's only growing about 7.8% expected for this fiscal year. But overall, this is a free cash flow machine. I mean, $12.4 billion in free cash flow. $14 billion in cash and short-term investments, and about $8 billion in total long-term debt. In theory, right, this company's free cash flow can pretty much cover this company's total debt if needed. Obviously, they're not going to do that, but it just kind of gives you it tells me an indication that they have plenty of cash. They have plenty of free cash flow. It's not something that I would worry about being a financial disaster in forms of their balance sheet. And it all depends on total returns over time, right? I think this is kind of the risk with investing is sometimes you're going to have years that you don't outperform the market. So unfortunately, in the past year, Salesforce underperformed the S&P 500 and the Qs. In the past 3 years, it beat the S&P 500, but it didn't beat the Qs. I think in the past 5 years, let's see how it goes. It didn't beat, but in the past 10 years, it did beat. It beat both, I believe, actually. Oh no, it didn't beat the Qs. So, I mean, it does have the opportunity. And historically, there have been times where it has beaten the market. Now, customer relations is definitely crucial. The question is, how is this company going to innovate with whatever is happening in the tech space right now? Has there been a growth in competition? But I wouldn't say there's limited growth, and I wouldn't say there's like a high risk either. But that's just from my top level approach, Neil. I don't know, Neil, if you follow the stock directly, but based on some of the metrics we'd see, would you consider this as a like slow grower with high risk regardless?
Yeah, I'm actually surprised to see that it didn't beat the market comfortably in the last couple of years. I was sure that a name like Salesforce would be up much more than this. Like you're showing us here the last 10 years, and it beats. Okay, it doesn't beat the Qs, but I thought a name like Salesforce, like a tech name, software name like that, would easily have beaten the market in the last 10 years, but apparently not. Now, I know that there were some issues I think 2 years or so ago, the company was investing a lot, maybe overinvested, and free cash flow was down. I'm actually trying to look at that. Free cash flow, did drop a little bit back 2021 or so. But since then, free cash flow has done very, very well. We're back at free cash flow margins of 26, 27 or so. So from that standpoint, if you look at free cash flow yield, I think you're getting a quality company. Revenue growth, now mid-teens should be getting back to high teens, I think. I think in fiscal 27 should be getting back to 10% growth or so. EPS bottom line growing faster than that. So yeah, I mean, it's a good company, I guess, but the fact that historically it didn't really outperform that much or at all is a question you need to ask, right? Because if you want to invest in software, in a software name, there are plenty of other companies that beat the market quite comfortably. Now, of course, risk reward wise, right now, Salesforce is financially very, very stable, right?
Yeah, Neil, I mean, we can see, right, the company has bought back a nice amount of shares. We've seen kind of, especially since 2022, well, they see a huge increase in shares outstanding. We are kind of seeing that pull back. And I know Salesforce is one of those companies that does a lot of acquisitions. It's definitely been a very acquisitive name. So again, I don't know if I would put this in like a high risk stock, but I also wouldn't put it in a high growth mentality either. Neil, especially with the numbers that we saw. But I'm pretty sure there might be other investors that would be comfortable saying, hey, look, this is a software space, like you mentioned, Neil, that financially stable, huge free cash flow, amazing balance sheet. And while it maybe might not have outperformed the market, maybe kind of the growth opportunities that the CEO is talking with AI agentic and some of these AI solutions and being a big data center player, it's that company that doesn't have much risk right now, but it could have that nice tailwind from AI that can maybe change around the story of, hey, look, maybe this becomes more of a consistent performance. And I think that's the great thing about the investing in general, Neil, especially individual stock picking, is just historical numbers don't give us future expectations. And it's good to understand the business to see where some of those tailwinds can go on from here.
Yeah, and I mean, I just checked. Free cash flow is expected to grow faster than revenue in the next coming fiscal year, so that's also probably good. But yeah, you have that question of AI. It's another company that's been put in two buckets. One, AI is going to help them tremendously, and two, AI is going to hurt their business. Remains to be seen what's going to happen with them. Of course, track record, like you said, plenty of acquisitions. I think that big jump that we've seen was from the Slack acquisition back then. So yeah, it's really up to them because they have the name, they have the power, they have the brand, the expertise. So it's up to them to seize the moment and seize the opportunities with AI. And then we'll see. Hopefully, maybe from today, 10 years from now, we're going to look back and see, oh, actually, they comfortably beat the market. But we'll see. I think as they generate more free cash flow, they buy back more shares, should be easier.
Neil, if you have any questions, feel free. I am doing quick research on a question that came in a few days ago. So if you have one, feel free to grab.
All right, let's see. There was one from Besties 20 hours ago. I don't follow all of these companies, but I think we all know the names on the shoe brand, Deckers, Nike, and Lululemon. Which ones you have the highest expectations for the next 5 years? Good question, because I mean, one of the reasons why Nike is under pressure is because of the competition, is because of Hoka, is because of On, maybe some mismanagement inside of Nike as well. Looking at Nike today, turnaround story, yes or no, remains to be seen. Earnings on Thursday, I guess we'll get way more information by then. Although in the previous quarter, the CEO did say that the turnaround will take a bit longer than expected, which I was not really surprised, because to go from a full refresh of a brand, especially in that sector, takes time, from idea, design, production, manufacturing to actually put it in store or online, usually takes a while. So remains to be seen. There definitely could be a lot of upside if it becomes successful. I just don't know if it's going to be a quick recovery. Lululemon is one that still surprises me. Still high margin business, still growing. Did have some issues last year with a new line that they developed, but so far, yes, it's expensive. Yes, I thought they would take a hit, and I was wrong. So I think they're doing well. On continues to do well. DEC, ticker symbol DECK, that's the one I do not follow closely, so I don't want to just say stuff. But if I had to rank them, I think on as number one, then maybe a Lululemon, and then a Nike, without putting DEC on in that list, because I just don't know much. So even if I put them first or last, wouldn't be so respectful to them, because I don't know much about them. So, Jose, do you know any of those names?
On a top level approach, right? I know on and Nike. And obviously I've heard of Lulu, but I don't know. I think this is a very interesting market for, say, a lot of competition. I think something that plays a big role here is just influencers, social media, because if one day one of these becomes uncool, a lot of people would follow suit, right? So not a market I tend to keep myself busy with.
Okay, no, fair enough.
All right, I have this. I'm still working on the other question I'm working in, but about 5 days ago, I sent the question to Bart. Let me kind of put it on our other studio chat real quick. So about 5 days ago, Real Madrid fan mentioned, "Hi Jose, can you share your views on the semiconductor index you use, and do you think it'll keep beating the S&P 500 in the upcoming future?" So let me just kind of pull it up real quick. Let me share my screen here. First, let me just say before we share your screen, I am very bullish on the semiconductor industry, and we are going to see that historically, a lot of these semiconductor ETFs have, let me do total return. Let me just normalize. So here I'm going to take a closer look at SMH, but maybe another semiconductor ETFs. Let's put, I think XSD is a little bit more equally weighted, I believe. I think so. I'm going to put in 2 semiconductor ETFs. The first one is SMH, and this is more concentrated. It has, I think, only 25 holdings, and it's kind of like the top 25 United States-based semiconductor companies. Spider, S&P, XSD, I believe just kind of follows any semiconductor ETF in the S&P 500, or I'm not sure if the S&P 500 or some subset, but regardless, it's a lot more diversified and a lot more kind of equally weighted approach. Now let me just kind of put them in order. I'm going to guess VanEck is going to be I'm going to guess which outperform in the long term thing. So, yep. All right. So VanEck in the past 10 years has done amazing, 806%. The Spider ETF in the past 10 years has done 423%. It's actually outperformed the Qs and the S&P 500 amazingly. Even the more kind of equally weighted has outperformed in the past 10 years. I believe we're going to continue to see the strength in a long term, I view. I think there are going to be years where, like we saw last year, I would say last year, in the past year, last year, I would expect maybe 3 years with this whole AI boom, you would expect kind of like semiconductors to be a little bit more exciting. And we kind of see with the SMH doing 86%, while Qs did 49 and S&P 500, we can see maybe XSD didn't do the best compared to the two, because the whole industry as a whole is still a little bit weak. The only thing that's really seeing any form of beneficial growth is the AI market. I'm going to guess, this is my wild prediction. Throughout the next 10 years, in the whole the next 10 years, if we look at the final 10 year, SMH and XSD will continue to outperform SMH, the S&P 500 and the Qs. The reason being, Neil, is semiconductors are used for any type of innovative technology we have right now. And I think we're getting into this world where, I don't know when, autonomous vehicles, though, I believe will be here within the next 10 years. That's going to drive huge demand in automotive chips. I don't know when, but I would say within the next 10 years, we will see an improvements in robotics. I know we're hearing humanoid robotics within the next 2 years. I don't think that might be happening, but I can say within the next 10 years, I think the chances of robotics being here is going to be a lot higher. And that's going to demand a lot of AI chips and just chips in general from various companies. We're going to see, we heard Meta is really believing that phones are no longer the new platform. We might go to things like augmented glasses or virtual reality glasses. Maybe that might not happen ever, but it's definitely not going to happen this year or next year. But if it does happen, I think it's going to be very highly within the next 10 years, or there's going to be some whole new type of computing platform that's going to change either your laptops, your tablets, your phones, or whatever, and see huge demand. So overall, innovation in humans, in my opinion, is going to be fueled by semiconductors. So within the next 10 years, looking at it 2034, 35, semiconductor ETFs will continue to outperform. Now, one thing though is this one's going to be very, very volatile in forms of price returns. I'm going to guess in the past 10 years, you're going to see, surprisingly not as, well, let me take off this one actually. Maybe this one's following it a little too much. You can see during dips, big dips, the SMH, which is the semiconductor market, took bigger hits, where this one during this point was down closer to 40%, where during that dip, we saw the other players not even down 30%. We saw it seems like the Qs was maybe like high 28s, and the S&P 500 maybe closer to 20%. So I'm going to guess there are going to be years like that where you're going to see more pain coming in from kind of the semiconductor ETF. So volatility will always be higher in the semiconductor approach. In the long term, I feel like if I can hold that volatility, I will be able to get better returns just via this ETF than the overall market.
Yeah, because I just checked, you got, I mean, in SMH, so the Van Eck semi ETF, you've got, of course, Nvidia as number one. That's basically now 18%. Then you've got TSM, that's 12.2, and then you've got Broadcom, ASML, Texas Instruments, actually close to 5%, and then Qualcomm. So, of course, when you see the drawdowns, you know why, especially back in 2022, because Nvidia did crash, what was it, 60% or so during that year. I don't know what the weight was for that ETF back then, but it makes sense if those are the names today, then you know that those names were also there in 2022, and those were the ones that got hit the most, but those were also the ones that did soar in the last couple of years, which is why you're seeing huge outperformance from SMH compared to the others.
Yeah, and I was kind of just taking a closer look here at some of the top holdings for XSD. And number one is Intel at 4%. Broadcom is number two with 3.7%. So you can kind of see like the difference in sizing. In the top 10, I actually did not see like any other popular stock in there. I think the most popular was actually Broadcom. So again, it's curious. It's going to be interesting to see it's important to see the semiconductor ETF approach. And to me, I tend to follow more of like a concentrated holding. And that's why I do enjoy maybe SMH a little bit better than the other players.
Yeah, because basically with SMH, what you get is already 30% in just two names, right? TSM and Nvidia. So that's already quite concentrated. Of course, it goes both ways. If we go down, then these go down faster than the ones that are less volatile. But if we go up, you definitely benefit from that.
And it changes, right? I mean, because you've seen it outperform even before kind of like Nvidia and TSM did it. So during the time, it changes to kind of match whoever is winning. So whichever one is winning becomes a bigger player, and the one that's losing kind of gets smaller and smaller. So that ability is, I don't know if Nvidia will be the driver of the next 10 years. I'm bullish in it, but even if it's another player, that would become the bigger portion of that ETF over the long term.
Yeah, no, I agree. I think they write it well. on one website, they write it, the top 10 holdings make up 71.85% of the ETF. So.
All right, Neil, anything you have here? We have about 9 minutes before we end this episode, and then we can kind of jump into another one.
There was a question, well, not really semiconductor related, but from Lovely Lily a day ago, more towards Rachel, but I think I can maybe add a little bit to that as well. She asks, I sold my Teladoc. I don't own Lucid Motors. My feeling is the same. Rivian. I own few and have and hope. What do you think of the two? To be honest, Teladoc Teladoc is a perfect example that even if your business is good and the idea is great, if it's mismanaged, it's getting destroyed. And I think that stock did reflect that in the last couple of years. As for Lucid Rivian, I'm very bullish on Tesla, of course, but I am very excited about a successful Rivian in the future. I think the cars look good. I think they've got a good idea. I think they partner up, strategic partnerships with Volkswagen, with Amazon, some investments there as well. Did they launch too many models like the R1, R2, R3 that they announced? Well, R2, R3 that they announced last year. Maybe too quickly, but then again, it gets people excited about EVs and specifically these types of EVs. So it makes sense. Right now for them, it's extremely important to try and ramp up. This year, believe it or not, they're not really expected to grow much. When you look at production volume and all of that, it's not really growing year over year. That could be an issue, but then again, in 2026, that's when their next vehicle should come out, and that should hopefully drive volume up and profitability as well. Because if you cannot produce enough, your margins are just not going to be better and better. Yes, they've done some cost cuts here and there. Yes, last quarter was an okay quarter, all things considered. But then again, if you really look at the numbers, you can see some small financial manipulation to make it look better, as always. But I truly hope that the Rivian becomes successful, because you need successful EV companies to accelerate the adoption of EVs. You don't want like EV startups to pop up and then they basically go bankrupt, because that's not a good look for the overall industry. As for Lucid, unfortunately, I just don't see them being successful. I think it's just too expensive, losing way too much money. Maybe they'll go private. I know the Saudis have a huge investment. Have an investment in them. So I think it will be quite easy to take them private and do whatever they want with that. So Rivian, I hope they're successful. I think they'll be successful because the brand is there. The cars are quite good, I think. So those are my thoughts. Any thoughts on Rivian, Lucid?
Not really, Neil, but I am curious. You mentioned kind of like Rivian was doing like really well with partnerships with things like Amazon. I think you mentioned Amazon and Volkswagen. With the Amazon, I'm guessing it's probably more in kind of are the trucks that I see driving around, are those Rivian trucks?
The delivery vans?
Yeah.
Like the blue one? Yeah.
Mhm.
Yeah.
That
was basically the strategic investment. And so Amazon had to put an order in Rivian, I think 100,000 or something like that, orders, if I remember correctly. But then because Rivian was losing so much money and they couldn't ramp up that quickly, Amazon basically, the agreement they changed the agreement, which would allow Rivian to talk with other potential partners. And it's not an exclusivity deal just for Amazon. As for Volkswagen, that's a joint venture. So they invest in Rivian. Rivian helps them on the software side of things. I mean, Volkswagen, you can also look at their financials. They're not really doing that great. BMW, their profits, they reported their profit dropped quite a lot year on year. In the last couple of days, they reported that profits dropped, sales dropped, super competition coming from China. Not that surprised, to be honest.
And Neil, I mean, usually when I think of EV, electric vehicles, because they're already kind of more tech focus, I feel like obviously EV is like the brand new thing. Are they just focusing on kind of just EV? Is that kind of like their core product? Obviously, you have a company like Tesla that focuses a lot on things like AI robotics as well. Are they just trying to become like just a vanilla EV company? And is that enough for the current car market that we're in, Neil?
Yeah, so Rivian is very focused on just their EV models. They also have their own supercharger network, but of course, most of the players have partnered up with Tesla because, well, it's the biggest supercharger network. It's the best one out there, so it makes sense to partner up with them. And then they'll, of course, come out with what they say is their own assisted full self-driving technology. How they're going to achieve it remains to be seen. At first, people thought that they would partner up with Tesla licensing, but I don't think they're going to go that way. So we'll see. But right now, yeah, the full focus is, of course, on making sure that you produce more cars, you sell more cars, because otherwise you're probably going to run out of money and go out of business.
Thank you for that, Neil. And I think we can take one more question before we have to reset the episode in about 3-4 minutes. So Ted has options 3 days ago. And Neil, I'll pass it over to you first. I think you can take this one. The new CEO of Intel is Lip-Bu Tan. And Ted has options, wanted to know if we have any opinions on Lip-Bu Tan's ability to attract more foundry business to Intel. Any thoughts there, Neil?
Yeah, I mean, I hope so, right? I hope so. As an Intel shareholder, I do hope so. And I think at the end of the day, it does help to have a specific name, a specific person with a lot of expertise as your CEO. But at the end of the day, you are going to attract specific customers if your product is a good one. Right? You can have, you take a Jensen, for example. If, let's say, in an alternative universe, you have Jensen as CEO as Intel a year or two ago.
I don't like this universe name.
It's great, but what is he going to sell? Nothing. So you need the two sides. You need a very good CEO and you need a good product. And I think we might be getting that perfect mix later this year with 18A and with Lip-Bu Tan as CEO. Then, of course, yeah, it's up to Intel and their employees to execute to perfection, because I think right now anything less than perfection is not good.
Yeah. Leo, I think I'm going to be saying the exact same thing as you. Is Lip-Bu Tan being a figure in Cadence CEO. He was the CEO of Cadence for over a decade. And he, being kind of that EDA software, probably has a lot of CEO's phone number in his cell phone. So the call could be a little bit easier, especially maybe someone who's been outside of the market, right? Pat, he used to be pretty much bleed blue. So he was just a Intel guy, and that's how you would know him. But this guy, Lip-Bu Tan, he's a little bit more rounded in the semiconductor industry. So it's a lot easier for him to pick up the phone call and say, hey, look, maybe come take a closer look at this. So I think he can probably bring the people to the door a little bit faster. But then it's going to be Intel's engineering team and Intel's product that make the final. It's like the product needs to be good for them to be able to come in with a signed contract or with some form of maybe just, yes, this is something we're going to look forward to. So I think it makes it easier to bring the customers to the door. But at the end of the day, that's not enough. You still have to have a leading product. And I'm pretty sure that's what you were kind of going with, right, Neil?
Yeah. Plus, I mean, don't forget that customer zero is Intel. So it has to be good for Intel as well, because otherwise, well, nobody's going to come, right?
All right, Neil. So that's the end of our first hour. So we're just going to do a quick reset, fools, but don't be sad. Neil and I are still staying here for another hour. So welcome back to another hour here of Fool24. And my name's Jose Najarro, and I am joined by Neil. Today we are going to have guested Tech Talk. We're just going to be talking about the tech industry. So for those on YouTube, if this is your first time here, feel free to join us on Slido.com with the code Fool24, where you can kind of ask us questions about the tech industry. And in the upcoming hour, we actually will have other hosts. So even if we can't answer it, some other host will most likely be able to. Again, what we do here is more just share our own thoughts, our own opinions, and this should not be considered personalized advice. That's something that we cannot give. We're just going to discuss how we handle it in our portfolio and give our overall opinion. So, Neil, any thoughts and anything else that I might have missed that you wanted to share to the viewers right now?
No, nothing specifically. We talk tech, big tech, semiconductors, fintech companies, some Chinese companies as well. And then if we don't know the company, we don't know the business, we usually do this on stream as well. We research it live. We even ask questions. You can correct us. So we do it all here. We
can either be the teacher, the student, or not, neither. Neil, I like this question from Ed, and it's something I sometimes hear a lot. So Ed, 12 minutes ago, after earnings, analyst price targets for TTD are still actually pretty high. So trading the trade desk, Stifle 122, and kind of leads with a whole different list of financial banks and financial analysts who all have kind of this price target over $100. I think most of them are over 120. Yet stock keeps drifting lower, now sitting at $54. What gives? So Neil, this is something that we kind of see a lot. But first, what are your thoughts on price targets? Is this something that you see bullish or bearish? How much do you kind of follow them? And is there anything you actually could learn from analysts when they give these price target reports?
Yeah, so it's funny because there is a video article that will come out in the next couple of hours talking about the trade desk. And yeah, the average analyst price target sits 107% higher than the price we're at right now, believe it or not. Even after price target downgrades, because the average analyst price target was higher before the earnings reports, but it still is 100% higher than where it is currently, which is quite crazy. Could be a huge overreaction, because usually if things are very, very bad, the analysts are going to downgrade and change the price target quite drastically. So you would have expect price targets of what, $80, $70, something like that. But the fact that we're still on average above $100 tells you that one, Trade Desk is an amazing company, first miss in 8 years. So again, I don't think this is a thesis breaker. And it tells you that Wall Street is still willing to give this company a high premium. Now, that's the trade desk. I'll explain in the video that I'm making why it makes sense, why it should be much higher, and why it is an overreaction. But overall, price targets, to be honest, love-hate relationship with those, because sometimes it's purely momentum chasing, as we've seen with plenty of names in the last 2.5 years or so. It's like, oh, the stock goes up, our price target is like 100% lower, so we have to update it, even though nothing really much has changed. Like nothing gets added to the thesis, you just put a higher multiple on it, and suddenly you get a higher price target. Same with the flip side, right? We had a stock with a price target of $200, suddenly it's at $100, so we're like, okay, doesn't make much sense. Our clients are maybe asking, well, how come your price target is basically double where the price we're at right now? What gives? And suddenly you get a price target update, stock is down. Why is that? Well, lower multiple, our assumptions are suddenly lowered, etc., but it is what it is. It's Wall Street. You have to play the game, because I've seen way too many price targets that really don't make any sense. Like remember, we've seen those price target changes, $96 to $97. Really, we need a note for a dollar change? Like it doesn't make much sense. And then when I see, this is particularly for Palantir, for example, a EV to EBITDA multiple for 2032 or something like that. I'm like, really? Are we trying to justify the price today because of a pricing metrics EV to EBITDA in 2032? Are we at that stage of the market? So some notes, I rather look at notes. Price targets are one thing. I rather look at notes and the reasoning behind it. If the reasoning behind it is purely a higher or a lower multiple, I disregard it directly, because you're just playing around with the momentum of the market. There is real reasoning behind it. You're like, okay, this segment of the business will grow 10%, that segment 15%. This is a high margin part of the business. That one, no. You add those things up. You put a 10x PE, 20x PE, depending on what business it is. And you're like, okay, that makes sense. That part I like way more than just a number and a multiple and maybe some momentum chasing. So yeah, rant over. How about you?
No, I probably could go with the same rant, but me, pretty much don't follow price targets. These price targets, like you mentioned, very momentum driven for the next 12 months. Stock prices as long-term investors, luckily we have more than 12 months for our positions to really show the fruits of their labor. And like you mentioned, I think while I don't follow the price targets, a lot of these analysts do have maybe some form of supply chain information, some form of expensive software, something that they could get a little bit more information than I can get through just reading earnings transcripts. So like I really do enjoy reading those notes and seeing if there's anything that I can add from there to my bullish thesis, or maybe something that is there that actually brings me more for like a bearish thoughts on some of the stocks I am bullish on. So I think the notes are very, as a long-term investor, I think those provide the better return on your time opposed to just looking at price targets. And this is something we're gonna see over time.
Yeah, I mean, there are some analysts that give out 18 months price targets, so a little bit more time. But yeah, I think more specifically to the semiconductor industry, we both like to read, for example, the semi analysis, their reports, less Wall Street driven, more information driven. So I think those are extremely useful.
Yeah, no, I agree. I think I enjoy those the most, where it's more like just research opposed to giving us anything stock related, because then you can kind of eliminate some of the incentives that they might have. And also maybe there's definitely a lot of research companies that just focus on research and not provide a form of financial entity either. So I like this next question, Neil, from Ed. And he kind of talks about Palantir. I don't know if you want to grab that one first.
Yeah, so Ed asks here, Palantir, is this a stock that investors should have a starter position and monitor over the next few earnings report to decide if it's a long-term hold? I think it's not just for Palantir. I think it's for many stocks out there. If you want to monitor, just own a share or a couple of shares, just as a monitoring position. Palantir specifically, of course, gets way more attention because it's a retail heavy type of stock. Not cheap. Actually, I mean, it's a sarcasm. It's expensive. It's expensive. It's not cheap. It's expensive. It's one that is growing fast and accelerating, but still, I mean, right now a market cap of $200 billion or so, and I think revenue-wise we're going to be at what, $4 billion maybe towards the end of the year or something like that, probably a little bit under it, depending on how much they're growing. So you're paying a very high premium. Of course, if you look at their margins, especially free cash flow margin, best in class, super high. So I would love to get it at cheaper. I mean, in the 60s, I would probably start buying back, because I was a shareholder of Palantir since they went public, direct listings up until $70. And then, of course, it went even higher. But for me, even at $70 with the information that I had, it already didn't make much sense anymore, like risk reward wise. Yes, of course, it went to 120, then it went back to 80. But it's expensive. It's a very good company, great leadership. Could grow even more in the future for sure, especially on the government side. I mean, 2 days ago, before AIPCon, they made what, 5-6 announcements suddenly that came out of nowhere, like agreements and partnerships. So definitely they have a lot of momentum. But that said, there is always a correct price to pay. So That's it.
And a lot of these stocks, right? I think that's one of the biggest kind of bearish thesis for Palantir and maybe some other AI stocks is valuations, especially looking at metrics like either price to sales or price to earnings, look pretty expensive. And there have been various times where even paying expensive high valuations for a stock can still yield amazing returns. I think one of the best examples is a company like Amazon, right? Then there's also times where paying an expensive valuation, I wouldn't say more likely paying an expensive valuation, that valuation, that stock price can continue to increase for multiple quarters. And then we finally see maybe the market feel a little bit different about the valuations, and you see kind of a steep stock price. So for me, if I do have a position in Palantir, and very similar to you, I think we had more of a cheaper dollar cost basis, so we didn't mind selling a little bit in the, or some of it, most of it, in the higher time. And now if I was to add into it, it would be very limited because it kind of increases my exposure into the AI space. So that's one thing that I keep into account. Hey, I'm already very bullish or very exposed into the AI space. Does this company increase my exposure in there? And if the answer is yes, my next question is, do I want to increase it even more than where it's at right now? So understanding portfolio allocations, I would say this is more of like, well, it is a leader in its space and it is kind of growing at rapid levels. This would be one of those high growth, high reward, high risk type stocks. Maybe not as risky as a speculative play like quantum computing, but definitely not a safe play in my opinion. Like maybe like one of the like a Google per se. So not as risky as that, but not as good as some of the other as with the crazy growth opportunity as well. But how is my portfolio looking? Do I want to increase my exposure on maybe a higher risk, higher valuation play right now? Or do I have too many of that in my portfolio already? Maybe should I look at some other stuff? So I think with companies like Palantir and just anything in general when adding into an investment is look at your portfolio allocation and see if this company, how it's going to change that dynamics, and are you willing to accept that dynamic?
Yeah, and I mean, I get these comments a lot, like, when are you going to jump back into Palantir? Because I like the company. I've talked about the company for 5 years now. And to me, it's like, I don't feel the rush. I don't feel the need to start buying, even if we are back now at $80, or I can't remember exactly what the number is. Yes, we went to $120, $125. But just because we're back to $80 doesn't mean that I have to buy back. Maybe I won't be buying back anytime soon, and when I buy back, we'll be at $100. Fine by me. But if I decide to buy at $100, that means that it makes sense for me. That means that suddenly the business did grow super quickly, even on a quarter-over-quarter basis. Like, that's what I'm waiting for. I'm waiting for that Nvidia type of growth, right? Not just year-over-year, 30% or something like that, but a quarter-over-quarter growth of 30% plus. That's when paying such a high multiple, high premium, makes sense. And at the moment, I think in the market that we're at right now, you said it, an Amazon, a Google, I'm much more comfortable. And then now I have all my devices trying to listen in because I said, hey, Google. And they're like, everybody, I can't understand what you're saying here. So they all want to listen in. But I'm way comfortable buying a company like that, where I know that the price that I'm paying today makes a lot of sense. Like an Alphabet, for example, today makes a lot of sense to me.
Definitely, Neil. Any other questions here that maybe you might want to grab? I'll be looking through it as well. Let's see.
There is one here from Late Adopter 25 minutes ago, talking about the Doge cuts to government workers and the impact on Accenture's bottom line. And I think it's not just Accenture. I think it's a lot of these software players that license to governments, and basically you pay per seat. I mean, from what I've seen is that a lot, ServiceNow is one as well, is that you have a lot of licenses that nobody uses. So you're paying for it and nobody uses it. And it could impact these types of software names for sure if they start cutting those deals, right? If you have an agreement and you're paying for, I don't know, 5,000 seats and only 2,000 of seats get used, then that's 3,000 seats less that the government has to pay, and 3,000 seats less that ServiceNow and Accenture and all of those are monetizing. So I do think that we're going to see an impact if of course all of those changes do materialize, and maybe that's reflected already a little bit in the stock prices for some of these names. And I mean, might not be great for shareholders, but as a taxpayer, you would like to see that, right? You don't want to see your tax dollars go to software licenses that nobody uses. It's just waste, pure waste. So we'll see. I think it could impact, but you're going to probably see some signs of, well, contracts being canceled or modified.
And one thing with Accenture is outside. I don't know how much software solutions, but they also do provide kind of like that. I want to say not engineering workforce, but like a workforce. They're kind of
Consulting,
like that.
yeah.
Consulting, right? And I was just looking through their past earnings, and while they haven't really discussed it in their last earnings, there was a Q&A session, and one of the analysts projected that the U.S. federal government is approximately 8% of its total revenue. So 8%, and you're definitely not you're not gonna see 100% cut here, right, Neil? So first, it's already starting from a small basis, 8%, and then within that, you're not gonna get 100%. So, and again, you don't know how much of the cut is gonna impact those bottom line numbers there, but from last earnings call, an analyst projected that about 8% of total revenue came from the federal government.
Okay, good to know. Then I'm pretty sure maybe ServiceNow might be talking about that as well. Probably they're all going to be talking about that in the upcoming earnings calls and conferences, because that's definitely a topic that they want to touch on.
I know Accenture has earnings this week, I believe. Yeah, March 20th. So I think they're going to give us a little bit more information. I wonder if ServiceNow reported earnings already. And again, this was based on last earnings report. And I want to say I think something went on. The last earnings call, while we kind of already knew that maybe some of these initiatives were going to happen, I don't think we really started to feel the front of it until like January. So I don't think we heard too much last earnings call. But in this, I think this upcoming call is going to definitely be a big topic for Accenture.
Yeah, and I think ServiceNow reported already. Let's see. ServiceNow, they reported a while ago at the end of January, so they're reporting at the end of April, so a while ago. So we're probably going to get more information in the next one.
I was trying to see, sorry, I got quiet. I was trying to see, because they definitely were at a Morgan Stanley technology conference. So I wanted to see if they had anything in the about Fed contracts, but they didn't really announce much there either. So again, maybe Accenture would be the best place to listen to. It's already been a nice amount, and Accenture, like we saw, 8% of total revenue, at least, is estimated to come in from that government.
Yeah. And I mean, ServiceNow right now, if you look at the stock, it's down 20% already year to date. So definitely taking a hit here.
Yeah, there's a question here that I think we can take. It came in about 5 days ago, and it was Vihan, and Vihan wanted to know, can we kind of go through the valuations of ARM? And if it kind of looks interesting at these levels, I know one of the stocks that we like in the semiconductor space is AMD. I think we both agree that there is some kind of nice tailwind for both the business and eventually the stock price, even though we don't know when that's going to happen. And I think, Neil, historically, we've kind of felt the same way about ARM, especially when it was trading over some of those crazy levels. I think they even reached to like over 150. And excuse me if maybe I'm making, I might be wrong here, but I think we both said that we thought it was a crazy overvalued stock. The stock has definitely taken a huge hit since then, Neil. It's kind of, it's sitting at $117 from its overall peak. The stock is down over 34%. So lost about over a third of its overall cap. Still sitting at a market cap of $123 billion, Neil. Any thoughts on ARM Holdings right now? And are there any tailwinds and headwinds that you enjoy for ARM, even though you're not a shareholder, and any headwinds that continue to maybe say, hey, look, this is not a stock I want to own at the moment?
I mean, even with the pullback, it's still not a cheap name. It's a very good name, a very good company, very important to the semiconductor industry and the ecosystem. Of course, you've got that Stargate project. Could be a huge tailwind for the company and huge acceleration of growth, which right now is still lacking, in my opinion. Headwinds. I don't think I see many headwinds. It's just purely pricing of the stock, because business-wise, they have a lot of momentum. They're doing well. I would have expected them to do much better, right? With everything that we're seeing in the semiconductor space, in the AI space. ARM is definitely a company where I thought we would have seen like a 50% growth quarter over quarter type of thing. We haven't. Far from it, actually. Far from it. It's still growing nicely, a super high margin business. But yeah, even with the pullback, it's much better today at these prices than it was, I don't know, what was it, 150 or something like that? Maybe even a bit more. Stargate could be a big game changer for them. Of course, if there were some reports, right, that they will start making their own chips, so competing with their own customers. I don't know how successful that will be, right? Good business, not the price that I'm willing to pay. Again, I'm quite comfortable with already my exposure to the semiconductor space and the AI, let's say, team.
Yeah. So Leo, I again, ARM is a good company, and we're kind of seeing kind of the growth opportunities, but will that growth opportunity match that valuation? I have the same question there, Neil. I mean, their growth opportunities, obviously the licensing of their ARM architecture. And you see that a lot in phones. And right now we're still kind of, I want to say, in a weak level in the phone industry. There hasn't really been kind of like a massive refresh cycle. If there is, those licensings can obviously increase in both their royalty and licensing revenue. So there is that opportunity. We are kind of seeing an increasement in ARM-based CPUs, especially from Qualcomm. And we've heard reports that maybe some other players might be starting to enter into the CPU business outside of the x86. And the only other competitor there is going to be ARM. So that could be another growth opportunities for royalties and licensing. If within the next few years, we kind of see more growth in smarter vehicles and autonomous vehicles, those chips will most likely be ARM based. Some of the top players there are Nvidia with their Orion, and I forget the other names of their chips for there, but those are ARM based. Qualcomm also has automotive chips, which are going to be ARM based processors as well. So if autonomous vehicles and smarter EV vehicles pick up, that could be a growth opportunity with that. And if robotics continues to grow, that's another avenue. If augmented reality and virtual realities, that could be another growth opportunity, as those chips again also tend to be very ARM based. And if data centers continue to grow their CPU, right now we're seeing more of a GPU growth, not much of a CPU growth, but if they continue to grow as well, there's more licensing powers and royalty revenues there. And I think that's my biggest concerns about ARM in the short term is there's a lot of potential, but a lot of ifs. And those ifs can take a little bit longer to progress to really kind of match the valuations. The second thing, Neil, is SoftBank is kind of the real player here in the Stargate project. I don't really see any real growth for ARM in the Stargate project. I think they even talked about during their last earnings call, Neil, that the only real reason they were kind of shown in kind of that tech infrastructure play in Stargate is because Nvidia's CPUs that are used there, which are going to be either the Vega or the Grace, are ARM based. So that's where they kind of were able to put ARM's products name into the Stargate project, but there's not much growth outside of there for ARM. And SoftBank, we see various reports that they are trying to increase the investments of OpenAI. They're pretty much the money cow of this Stargate project. And for them to be a money cow, they're going to need to sell a lot of ARM shares, in my opinion. And I think that's probably one of the real reasons we've seen kind of ARM stocks take a hit and not really see much of a correction like some other semiconductor stocks. I feel like some other semiconductor stocks from that bottom that we saw a few weeks ago, some of them are up over 15, 20%. I think ARM is only up about 11, 12%. I'm going to guess there might be some selling happening by SoftBank to increase that cash position so they can fund that Stargate project. And I think that's going to continue throughout this year at least.
And yeah, to be honest, it would make sense, right? To be honest, it would make sense. The moment $124 billion in market cap. So year on year, I'm seeing right now, year on year, the stock is actually down 9%. So it actually peaked at around more than expected, $180. So yeah, well, this one went very, very high, very, very high. So yeah, I wouldn't be surprised if SoftBank starts to cash in a little bit, because I mean they did promise a lot of investments, so these investments need to be paid. And when you hold ARM and it's $124 billion, I think it's a good opportunity for you to sell some shares, of course. I did do a quick search for ServiceNow, and they also had a Morgan Stanley conference not so long ago, and they did touch on Doge and they did touch on federal government cuts a little bit, and the comments were, we know this is happening. They say that every time there's a new administration, they're looking to cut some cost efficiencies and all of that, and they say that they emphasize the federal government's focus on efficiency and costs that would reduce the reliance on old systems. So basically, ServiceNow is like, you know what? Still use the old systems, but we want to integrate with those old systems to make them better, to basically automate a lot of it, which would make all of the employees more efficient, which eventually should save you quite a lot of money. So they took that question and flipped it around and basically told the analysts, look, we know, we see the opportunity. It's our game to win here. There might be some cost cuts, but eventually we think that we can be a winner when all of this ends, because according to independent research, let me make sure that I read it here. Based on independent research, they talked here about the fact that the average person in an enterprise today swivel chairs in between 17 different application experiences a day. So they say here, based on independent research, not mine, this is at least 30% of their productivity that gets drained out just because of the inefficiency of enterprise application software. So I guess if they can prove that they can fix that, probably the government will still continue to pay, and maybe pay more for a service now than they do for another solution. So we'll see. I know ServiceNow, I mean, great CEO, great company, great track record. So I'll probably assume that they're up to date with the sentiment.
And Neil, I would love to hear your thoughts. This is a question I feel I've seen on Fool24 before, but I've never really answered it. And I tried to look the question to see if it was active, but it wasn't. Right now we're seeing, obviously in the Fed, a lot of kind of cost cutting, and maybe a little bit more aggressive than we've seen in the past, to say the least. And we're also kind of hearing of kind of every business wants to be efficient, want to cut costs. Do you think with maybe the current sentiments of the uncertainty in the market right now, that one of the biggest things that AI mentions they can do is become more efficient and kind of provide better cost solutions. Do you think the current market that we're in is actually more of a tailwind for the AI space, or more as a tailwind, or really much no difference?
Interesting question. I mean, you would assume that it's a tailwind, right? I mean, if you look at the DeepSeek scenario, for example, right, it's doing more with less, and that was a negative thing for the market because the market crashed. But then every single player said that, look, this would have eventually happened, and this would just make AI more accessible. So it's a positive. AI should be making things cheaper eventually, so it should be a tailwind. Now, I'm still not convinced when you hear those executives say that, oh, AI will create a lot of new jobs, it will not replace jobs, blah, 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 and all of that. I think a lot of jobs will be replaced actually because of AI, because of robots. It's up to us, I guess, to make sure that it does create a lot of other jobs, or to make sure that people that lose their jobs because of AI have something else. Because how are we going to deal with that if a lot of these, let's say, bottom level jobs at certain companies get replaced, even coders and all of that get replaced by AI? What are the others going to do? Is that how we're going to get unemployment rate above 5%? It's also not great. So tailwinds, also headwinds, I guess.
Yeah, because this Meta platform, I think in their latest earnings mentioned that they believe by the end of this year, we will have kind of mid-level, at least them for internal uses, they I think have about, they mentioned mid-level performance coders, or mid-level engineers. I mean, so if that's the theory, why would, if you have a lot of infinite mid-level engineers, why would you want to get an intern or an entry-level engineer? So I think it's, I think obviously a lot of these thoughts are very bullish in the short term. And while they probably might be like mid-levels in certain aspects, they might not be able to do everything. But it's definitely an interesting time to be here with the AI market, in both not just, like I mentioned, maybe some of these heavy manual labor jobs with robotics, but then with AI agentic solutions on kind of like those coders and more tech-oriented jobs as well.
I mean, it's quite strange, the question that I'll ask you, but maybe we're going towards that. Do you think that there will be a quota in the future where you need to have at least X amount of real humans in your company?
That's what I would think, and I mean, oddly enough, Neil, and my wife, me and my wife were discussing this, and that's one of the things that I thought were eventually we're going to be like, okay, you can estimate how much a human work can do in forms of work in 8 hours, right? So I think that would be kind of like the benchmark of AI. So if it's like one AI equals that same amount of work during that same amount of time. And I think eventually you're going to have, at least starting off, right? Because if AI is really, and again, it's all depends if AI is really as revolutionary as it comes. It's like, if it's really as this crazy, you can have probably massive layoffs, but I think there's going to be some control of it as well, where you're going to be limited to maybe how much AI you can technically use before really progressing or have some form of quota. How about you, Neil?
I mean, it would make sense to have like human as a percentage of revenue. Like, this is going to be a future metric. But it would make sense to make sure that at least there is like some stability in society. Because I mean, the other solution is probably universal basic income, but I don't think I mean, it's a whole other conversation, but I don't think that's a good thing, and that could lead to even more inflation in the future. Although you might say that AI and robotics is deflationary. You can make things for extremely cheap, like basically robots can work 24/7. You don't even have to pay them a salary. So basically, all the goods that they produce, you can sell them for much cheaper, yet your margins are going to be better than where they are today. But then you can say corporate greed, right? Because a company can suddenly be making way more money in the future and still not want to have humans just for the sake of having humans and paying them a salary. Could be. Do we then want government to intervene and say this is the minimum that you have to do? Maybe, like the minimum wage, minimum amount of humans at the company. I think it would make sense. To be honest, I think it would make sense, and it would be pretty good for everyone.
And Neil, enough of us with our AI conspiracy theories here. We do have a question that just came in, and appreciate Ed for breaking our thought process here, or bringing us back to reality. So Ed, about a minute ago, spring is coming. So is Home Depot a good investment at current prices, or it's expensive due to a slowdown in retail spending? And Ed, I feel like I don't own Home Depot. And Neil, for some reason, I'm gonna guess you don't own it either. No. And I think when it comes to stuff like this is kind of, I would say a cyclical space, very similar to the, maybe not similar to the semiconductor space, but you can kind of see very similarities that there's going to be certain times when, or just any other types of business, there's definitely certain times that are better than others. And the market kind of sees that already. They already understand that as spring comes, or as we get closer to summer, more people are likely to do more gardening work, more likely because it is warmer outside to do more house jobs as well, because who wants to be changing anything when it's cold outside or crazy rain. So this cyclicality is something that's already expected within the industry. Just like in electronic semiconductor industry, you tend to have maybe a big Q3 as a lot of stores start to buy a lot of inventory in preparation for the holiday season. And you tend to see a very slow Q1 because there's no more point in buying any inventory, as there's not going to be any sales for some time. And the market already kind of prices that in. The market is already somewhat smart in that. Now, the real question is, how much are they expecting? And I think that's the hard question. And I think, Eddie, you brought up such a great point with, is it expensive due to slowdown in retail spending? And it's like, we don't know if retail spending is really going to slow down. Right now, we are seeing kind of like the sentiment of consumers slowing down, but at least we are still seeing, I mean, all the earnings these past, at least for most players, you know, I think like all these earnings have met expectations. So it seems like spending was still strong, at least for the holiday seasons for right now. Now, the question is not, is the wallet actually changing, or is just the mentality of whoever owns that wallet that is changing? And that can maybe create some volatility. And that's why I believe we're seeing kind of guidance being a little bit more conservative, because we don't know how people and the wallet holders are going to change with their mentality. Money can still be the same. There might not be any changes, but just the mentality could change that can prevent some of the things. And unfortunately, we will have to wait and see for that. But for a company like Home Depot, obviously, if they don't meet expectations, and if you kind of see a slower market than historically expected, then you could see prices go down. So Ed, I know that wasn't an answer, but something like this, I think you really need kind of like a crystal ball, and you really can't have a final answer until you really see the data points, and that data point is going to be earnings. Neil, any thoughts there?
No, I agree. I think one important data point is probably going to be interest rates dropping, making sure that builders start to build again. So, of course, more houses, a Home Depot, a Lowe's, something like that, will definitely benefit from that. Lower interest rates, more people may be inclined to move, buy a house, etc., etc. You have to look at those things. If you suddenly see a rise in the housing market, could positively affect a Home Depot, for example. But yeah, like you said, we're strange macro environment at the moment with this ups and down tariffs. We'll see what happens. The past couple of weeks, most of the card players, financial players, they all said that the consumer looks healthy. So there is that. Of course, things can change in the next couple of months for sure. But for a Home Depot, it's focus on what's going to happen with the housing market, what's happening with rates, mortgage rates, and all of that. It's basically a domino effect, right? Rates come down, mortgage rates come down. You maybe also more builders, more people building houses, and that's going to affect a Home Depot more positively. And plus, yeah, summer weather also makes sense. You always have some crazy plans for the summers where you want to build something for your kids or you want to renovate something in your house. Usually do this spring, summer because it's nice weather. So yeah, I think that could be catalyst for a Home Depot. Whenever that will happen, I don't know. But those are the things that you should be looking at for sure.
Yeah, and I think more of just like a investor mentality, Neo. I think it's important that small events like this of just seasonality change shouldn't be a long-term thesis. At least it's not for me. I remember one of my first early mistakes, Neo, was I when I first started investing, it was around the time when like Disney had just really bought Star Wars. And they were kind of thinking about releasing a new Star Wars movie or something like that. And I was like, oh man, this is going to be amazing. You're going to see this huge change. And I was looking more for like the short term. And obviously you might have seen like a small blip, but movie revenue is not that big for Disney in forms of total revenue. So while I thought that, hey, look, something like this could make a big impact, it really doesn't. And if it did, the market would have already expected somewhat of a growth in movie sales and stuff like that. So I think as an investor, you're not looking for seasonality changes. I don't think you're looking for small yearly changes of whatever being consumer spending or anything. You're looking more of the long thesis is, can this company improve margins from here? If so, does it have a good business plan? Is management going in the right direction? I think that's more important than trying to kind of time some random event to see if that would cause the stock price to go up.
I mean, from that specific example, it could help. I mean, it definitely does help. Same with the Marvel acquisition, the Pixar one, because it's movies, but it's of course merchandise, future TV shows, attractions in the parks, trickle down effect for sure. Now it can have a negative effect as well if the movies suck. So if the movies are bad, I'm a Star Wars fan, so in the last couple of years has not been great. There were a couple of good shows, but overall, not great. Even Marvel after Endgame, not great either, but we're not going to turn this into a movie and show reviewing hour. But yeah, I think we can switch back to Nvidia because there was a question about that from Pro Shop Guy 4 minutes ago. In January at CS, Jensen Huang announced Nvidia was entering physical AI support. What are your thoughts on Nvidia's opportunities in this space?
So I mean, massive opportunities here for Nvidia in the robotic space. And physical AI, for those that are not familiar, is kind of adding AI solutions into something that we can really see here, or something in the real world. Right now, typical AIs are just large language models, and we kind of see it more in like the software space. But a few of the things, the most popular, is robotics, and the most popular is humanoid robotics because it's getting all this trend. And the second is autonomous vehicles, as that's another form of AI kind of really bringing into the real world. But outside of that, there's a lot of more physical AI that we can kind of see in the robotic space. You don't just have humanoid robotics. You already have kind of a lot of industrial robotics from kind of like just those moving arms. And that all these AI solutions vary. One thing that they mentioned, Neil, in the healthcare conference is a lot of these healthcare equipments are a form of measurement. But if you can integrate already AI, be it some form of extra chips, some form of extra training, some form of extra software, that measurement now becomes a form of AI tool where it reads your blood, it reads your x-ray, reads whatever type of imaging you might do. And based on the data that it has, it can kind of already create maybe some answer, not an actual doctor answer, but it can create at least a nice roadmap for the doctor where they don't have to start from point zero and they don't have to create that roadmap. And it's already kind of been created by AI. And through all those, NVIDIA can provide various solutions. First is just the overall infrastructure. I mean, they have various data center chips that are going to be used for kind of training whatever type of model, being the autonomous driving model, the robotics model, the healthcare blood test management model, the blood measurement model, whatever, so on. So they have that for the data centers. Then they also have chips that can be used more on like the consumer level. In maybe your hospital, you might have like, they do have certain products that meet the requirement of the health industry and don't have the kind of issues that maybe your typical consumer product can have. They sell type of hardwares for that as well, via their GPUs, their workstations, a lot of other infrastructure for those spaces as well, which can help with handling that internally opposed to running it in the data center. Outside of that, they also kind of have the software. They have various simulation solutions that if you want to kind of train these models, if you want to train it on your own data, you can run the simulations on software, pay a fee for it. So there's a huge amount of growth opportunity here. And again, it's not just the two popular, which is autonomous vehicles and robotics. Or in smart homes, there's various ways that you can kind of have AI into everything that we do. So I think smart homes can, smart homes seem pretty cool in 2010 and still do with a lot of products, but I do believe with the integration of AI, it's finally going to be a viable solution, where I'm not going to have 20,000 apps to turn on, one to turn on my light bulb, one to lock the door, one to do this or that. I think eventually with things like AI agents and AI innovation, you'll be able to have like one super app to be able to really control your smart home. So there's a lot of growth opportunity with physical AI. And I think I was looking at the different conferences and presentations that are going to happen during GTC. And GTC, like I mentioned, is the most important is the keynote that happens on Tuesday, but it's about a 3 to 4 day event filled with a lot of different presentations. The presentations, Neil, that I'm seeing the most are all correlated with the robotic space. So it seems like this is two markets. The first is the robotic space. The second is AI agents. So this is where I believe Nvidia sees the biggest growth opportunities right now with AI in the upcoming year. So I'm going to be listening to a lot of the robotics field. So feel free to come in later throughout the week, maybe closer to Thursday, and say, Jose, what did you learn about the robotics market from GTC? I think I will be able to share a lot more information there.
Yeah, so I think you also mentioned the manufacturing and logistics side of things. Huge opportunities in the trillions of dollars. And during GTC, now that we've been talking about that, I think we're going to hear a lot more about Cosmos, right? The platform that he touched on during CS. I think we're going to hear a lot about that. And it's going to be quite interesting because for AI agents, for all of this personalized stuff, you are going to need a lot of memory. And players like SK Hynix and Micron are definitely going to benefit from that. And to be honest, like you said, smart homes were great 15 years ago, super exciting. Today, still very exciting, but we are all waiting for Jarvis, right? To have a Jarvis in our home. You get home, hello, sir. How are you today? Oh, thank you very much. Eventually, I think we're going to reach that eventually.
And that's the real way, Neil, to kind of get into this AI future is for AI to actually be extremely cheap. Because, right, I mean, right now we're paying, if you want the top of the edge large language model, you're paying $200 a month for the top of the model. So imagine what type of monthly subscription or type of computational power you would need for a robot that's just thinking nonstop 24/7, right? So that for that to happen, you need AI to get cheaper. And that kind of inferencing, this is why NVIDIA wants AI to get so cheap, where you have what they call AI factories. And AI factories are a form of a data center. But instead of running kind of like cloud solutions, their whole point is to just generate tokens, because you're going to be fueling all these tokens with all these AI applications that are running 24/7. So it's weird that DeepSeek was such a bearish thought for NVIDIA, but NVIDIA's actual goal is for AI to be so cheap that you don't have to worry about the cost of running a robotic inference solution 24/7. You don't care about having millions and millions of cars in the road, because there are these AI factories that are able to do that, all pretty healthy.
Yeah, and that's basically what we said when DeepSeek happened, right? We said at first, let's say you have a hundred folks that use a specific product, they pay $1 or $2, let's say. But if you can make it that 1,000 pay $1, you are still making way more than before, yet it costs the consumer half. And I think that's what's going to happen. You're going to make sure that AI is accessible to millions of people and not just a few tens of thousands. And that's how you monetize the whole thing.
Yep, definitely. So it's going to be interesting to see what we hear here in GTC. Again, the DeepSeek moment was such a scary thing for Nvidia, but in a recent conference, Neo, Colette, the CFO of Nvidia, mentions that Nvidia itself has reduced the cost of inference by 200 times in the last 2 years. So this is the future that they want to build. Yeah. So Neil, I have another question here that came in a few minutes ago. It was by Saul Column, and we kind of talked about it in the previous episode. But Jose, any updates on your current thoughts on SMH? I added to my watch list based on your comments back on September 2022, and it hasn't moved much, plus 11%. So at September 22, and I'm guessing hopefully it's September 22 of 2024. I believe the stock has, I'm gonna guess SMH has moved more in the past 3 years than that. But again, I think, let me see, past 3 years, it's up about 86. So, okay, it's probably more in the past 6 months or so, which would be around that. So to me, so column, I kind of talked about it in the previous episode, and I made this wild prediction that I still believe the semiconductor market will completely outperform the industry when looking at a multi-year time frame. So if we kind of go into the future from now, 2035, I believe looking at a 10-year and 2035, looking at a 10-year time frame of the semiconductor ETF and the Qs or the S&P 500, SMH will be a complete monster. And that's because of some of the things we just mentioned, right, Neil? The robotic space, AI integrating into various solutions from smart homes, from medical devices, from all types of mobility robots, from all types of industrial solutions. I think there's going to continue to be a huge demand for chips. And as technology, at least for now, technology is really being pushed by the innovations of semiconductor industry. Now, that doesn't mean that every year SMH is going to perform better than the S&P 500 and the Qs. There's going to be years where maybe valuations might have just gotten a little bit ahead of themselves, and there might be a year that might be down or might be pretty much flat while the others perform a little bit better. But for me as a long-term investor, I still am very much in the case that in a 10-year time frame, that it's going to completely demolish the overall ETFs and index.
So if you had to choose an ETF, you would go with the semiconductor ones?
Yes, if I had to choose an ETF, I would go more with the semiconductor player and one with a little bit more concentration. I do enjoy the concentration in kind of more the advanced solutions. I think the kind of mature nodes, while they are great businesses and they're like, they have great opportunities, there's a lot more competition. I think in the advanced plays with like your Broadcom, your AMDs, your Nvidias, your TSMCs and the equipment players and the software players that deal in that industry, those are the ones that are going to be driving the future. And those are the, if I was to look for a semiconductor ETF, SMH, you're going to see probably has most of those within its top holdings. And like you mentioned, in the last episode, the top 10 holdings were about 70% of the overall portfolio. And I believe that's the type of ETF that I would want to own.
Okay, fair enough. Now, more difficult question is if you had to choose one semiconductor stock or exposure, so either an ETF or one particular stock to buy and hold, which one would it be?
I'll answer both actually, Neil. So if it was a ETF, I think I would go with
No,
SMH.
it's only one.
Oh, only one.
Mm-hmm.
And for how long? Or just overall in forever?
Yeah.
I think I would just go with the ETF forever. Yeah. Or even if you tell me if for the next 10 years, I can't do anything with my portfolio, if I can't buy or sell for the next 10 years, and I can only buy either one stock or one ETF, well, I am somewhat of a gambling man. I'm not that big of a gambler. I think the best thing would be the semiconductor ETF, where in the next 10 years, I'm very bullish that it will outperform the overall market. And it doesn't matter if I pick the right or wrong stock, my money will improve dramatically.
Okay, no, fair enough. Fair enough. I think it makes sense, especially if you look at the companies that are inside, for example, an SMH would make sense because that's probably also one of the names that you would own or want to own, probably own as well because you own Nvidia. So that being the number one would make sense.
I think we have room for maybe one quick answer, and then one quick question. And then we will have to do a quick transition to the next episode, which seems to be a really great interview, but we'll explain that in a bit, about a minute or so. Is there any question you want to take, Neil, or maybe not a question? Are there any thoughts that you have for the upcoming week, Neil? I know we have a lot of earnings events, but I do believe we have a lot of macro events, Neil. And any thoughts on? I think you follow maybe the macro events a little bit closer than me. Any thoughts on some of the events coming this week?
I mean, the week that we just had was a big one, right? With the CPI report, PPI report coming in actually better than feared from an inflation standpoint. So that's good. There are a lot of surveys out there, consumer sentiment surveys, especially the one that came out on Friday from the University of Michigan, which again, it's you can tweak it, you can play around with it, you can ask specific people a specific question, and then of course you can manufacture the results. I mean, I'm looking at one thing right now. The University of Michigan expected change in business condition in a year is the worst that it has been since, what was it, 1970s or so. And you cannot convince me that this is reality. I mean, are we worse today than the great financial crisis? I don't think so, right? I don't think we're worse today than when a pandemic started, or was it at the dot-com bubble or whatnot. So I don't know. I think we see a lot of macro headlines that are scary, but don't always make a lot of sense, right? Today, we've spoken about that in previous streams, compared to where we were at the peak in 2021. Today, we are in a much better place, right? Inflation is coming down. Interest rates are coming down. We're expected to come down, not the opposite. So to say and to see the results and say that we are in a worse condition ever, worse than the great financial crisis, it doesn't make sense to me. Not even a little bit.
All right, Neil. So I think that is the end of our hour. For all the fools watching us on YouTube and on our Fool platform, stay tuned. The next hour is actually the next hour and 15 minutes. We're going to be running a 75-minute interview with HireQuest CEO Rick Hermanns. And after that, we will be following up with another live show with Fool analyst Asit and Brian as well. So if you have any questions, feel free to keep them up here on Slido. Feel free to keep asking more, and enjoy the interview and enjoy the rest of Fool24. Neil, thank you. And thank you again to all the fools watching.
Bye-bye.
Hi, fools. Welcome to the Motley Fool, another CEO conversation. I'm Andy Cross, joined around the table with Jen Elliott, our chief of our HR people team, Tom Gardner, our CEO and co-founder of the Motley Fool. And we're happy and very proud and excited to talk to Rick Hermanns, the CEO of HireQuest, a recent recommendation of ours, a temporary workforce hiring and professional recruiting specialist, national-wise franchisor with 440 locations in 47 states across the United States. Rick, welcome to the Motley Fool.
Thank you, Andy.
Yeah, excited to have you here. Rick, maybe we'll just start it off with an introduction of HireQuest. Tell us a little bit about your business and how it got started, and what are you really specializing in trying to solve with HireQuest?
So HireQuest, HireQuest is a franchisor of staffing and recruiting firms. And so we're a little bit unusual in the staffing industry. There are a couple of other companies like us, but basically, again, we operate almost exclusively through a franchise network. And so where that has a major implication, and so like what we really strive to do is to provide value to our franchisees. And the staffing industry, for example, has two major problems for somebody wanting to get into it. It's fragmented, so on one hand it's easy, but to say it's easy is really understating the issue, because there's two things you need. Number one, you need money. So imagine if you're Sue Smith, you're a great manager at Adecco, you want to start a Snelling office, and you don't have, where are you going to get the money? Because obviously you're paying your workers, weekly, or actually in our HireQuest Direct division, we're paying daily. And then, you're not collecting your money for 4 to 6 weeks. Well, that requires a lot of money. And so even if Sue Smith was a great manager for Adecco, she doesn't necessarily have $250,000 lying around, under her mattress. And so we supply our franchisees with money, with at least not our recruiting division, but our staffing divisions. So we supply them with money, which is a huge problem for somebody looking to get into the staffing industry. Second thing is workers' comp, and that's especially on the HireQuest Direct side, but even on the normal traditional commercial staffing, insurance, workers' comp carriers don't particularly like. That's an understatement. They hate staffing companies. And so we solve two of the biggest problems, the two biggest difficulties to get into the business. And so it creates a bit of a moat around what we do. So sort of to answer your question, hopefully, is to say that what we do is we fill a need within the staffing industry. And now you could, if you were that same hypothetical Sue Smith that I'm talking about, yes, you could go to a PEO, which is a professional employer organization, to have them do all the back office and basically get the workers' comp for you. But they're going to charge a lot of money. The second thing is, and then you can go to a factor. There are little finance companies that'll, they'll charge you 2-3% of your invoice to finance those. But again, you put those together, and that cost almost wipes out, it equals what our royalty is. And, so you're right back to where you started. So again, that's where our value proposition comes in. And, the other part within that then is that, and then fundamentally, let's say our strategy, our advantage is simply that we bring sort of the aggregated scale when it comes to, processing payroll and finding workers' comp and finding financing. And yet then we deliver it to, sort of small business people who then have a greater stake in how they handle their clients. And because the bane of, let's say if you're one of the larger staffing companies, your company owned, is, how do you, if you have, let's say 50 offices around 12 states, you have to build this big infrastructure to manage these offices. Whereas, and you're going to have a lot of clunkers in there who aren't, not to say that you don't have some great corporate, corporate managers. There are some that are great that I would love to have as a franchise. But by and large, you start getting turnover, and turnover is a killer. Any personal service business, it's the biggest killer, right? You go to your barber, and it's like, oh, so-and-so's gone. And it's like, well, really, I didn't go here because you're Acme barbershop. I went here because old Tom has been cutting my hair. So it gets to, we reduce turnover dramatically. And that's why if you look at it, and it's kind of funny that, so for example, our income levels as a percentage of sales generally isn't far off of any other one of our peers, any other staffing company. And yet probably 2/3, like for whatever dollar we make, our franchisees are making probably another $2 on top of it. So the thing is we are far, far, far more efficient because we really don't have that middle management. Now, sorry, I know that was a really long answer to that question, but it kind of gets to the guts of what we, it gets to the guts of what we do and why we're there. Now, by the way, just a little bit of background on me. I got in this business 35 years ago. I started to work for a company in South Florida called Labor World USA. Started having a lot of problems. I was their CFO. I had come out of banking, worked for them, but then long and short of it, again, we had problems. I became a franchisee of theirs. But then they recovered, and they bought back a bunch of my offices in the late 90s. I took that money, expanded it, company owned, and it was kind of funny how I saw it. So as a CFO, we stayed in business by selling our offices as franchises. Funny enough, everything went well, company's preserved. Then you go 6 years later, they decide to go public. So they buy back people like a lot of my offices. 2 years later, they're broke. And it goes back to the incentives of having people who, in the branch that actually care about their business. And so, I would, if you took a group of 100 offices, I would stack our franchisees against any group of competition's company-owned stores. And again, that's not a knock on the individual people. It's just too hard to manage it from afar without those incentives. But basically, we got our hats handed to us when we sat there. I got a nice payout from my former franchisor, decided I was going to just start opening a bunch of offices because, well, they're going public, so can I. And it's sort of like it turned to crap. And so it's like, you know what? This is a lot easier being a franchisor. And so we basically converted all the offices to franchises. And so we've pretty much been 100% franchised for 12 years.
That's outstanding. You've been on both sides, on the franchisor and the franchisee. Jen Elliott, why don't you jump in with a question for Rick?
Yeah, thanks. Rick, I'm curious, across your family of brands, you've got Snelling, TradeCorp, MRI Network. Do you have an estimate on what percentage of those roles that you fill across all of your company are considered unskilled or semi-skilled versus skilled? Because I'm curious about how all of those opportunities and challenges that you just laid out vary based on, if you're filling CDL drivers versus professional roles.
That's a good question. So CDL drivers, by the way, is a very small component of our business. We have a division called HireQuest, but it hasn't really taken off the way we would have expected. So we have our HireQuest direct division is our truly unskilled labor division. And think of a person carrying a shovel or a broom or unloading a truck or sorting trash at a recycling facility. You think of that, that portion of the business is probably, don't hold me to I'm giving you ballparks here, but that's probably 40% of our business. Then as far as I would say, semi-skilled, which would be your traditional, staffing company. You think of, I need to bring in a secretary for 2 weeks, or I need a forklift driver for a month, or whatever it is. That's our Snelling division. That probably accounts for maybe 25% of our business, probably pushing more like 30%, which those would fit if you were benchmarking it against some of the stuff that, let's say, the staffing industry analyst or any of that puts out. That fits squarely in what they would call the industrial, sort of the industrial portion of the staffing industry. Now, our TradeCorp only started about a year and a half ago. That's a question of where you'd sit there and say, is that skilled or is that blue collar? And it's blue collar from the perspective of it's electricians, it's masons, it's plumbers, so they are skilled, but they're not professional from the perspective of an accountant, a banker, et cetera. And that's a new division. That's probably 2%, 2.5% of our business now, but that's growing a lot, and that's something we're really, and I would expect more of it. I think that the demographics of it are great for us, and the characteristics with respect to even with our HireQuest direct division and how much business we already do with contractors. It's a natural, extension of what we do. And then MRI is our professional recruiting group, and that's probably about another third. That's probably another 25 to 30% of our business. That's where it could be, CEOs being placed, chief marketing officers. Although we do have a sort of a contract staffing division within that, and we might be placing industrial engineers or cybersecurity experts. So there's, that's your professional division. So that's, like I said, 25, 30% of what we do.
And that ratio breakdown, are you looking to radically change that anytime soon?
Well, so we are historically and realistically in the futures, at least as long as I'm still on the right side of the grass, we're gonna, we're opportunistic. If a great professional opportunity came, well, then we would grab it. If a great unskilled opportunity came, we would grab that. I will say, though, that it's more apt to stay industrial than it is to move towards professional, simply because to a large extent, we also arbitrage. We're really arbs, because what we'll do is we can buy a day labor company at 3 or 4 times earnings, flip it, either sell it to one of our existing franchises or convert it to a franchise, and and realistically, then our multiple applies to it. And so it's almost, I'm not going to say it's impossible for us to screw up, but it's hard for us to screw it up, because we've got a lot of, it gives us a lot of leeway to have some attrition in the client base. Although, again, because we're a franchise organization, we don't tend to have that. The staffing industry is littered with companies who it's like, oh yeah, we're going to grow and we're going to roll up companies and buy them. But then they lose 45, 50% of the revenues within 6 months. And it turned out it's a horrible, it's an absolutely horrible acquisition, because they lost half the business, and there's not enough cost savings to nearly cover that sort of a decline in revenue. So, that's where, where that plays in. And the point is that typically, unless you've got just an iron stomach, what happens is, if you buy an IT staffing company, you're going to probably pay 10 times earnings. And we don't add then enough value necessarily to our franchisees to, to where then they could pay us back for that high multiple and become a franchise. So it's a harder sale for us. So once again, a really long answer to sit there and say, I would expect us to stay more towards the industrial and commercial staffing. But again, it just depends on what opportunities present themselves. Like right now, healthcare is not a particularly great environment. So, opportunities might exist that never would have existed 3 years ago.
Yeah, no, I hear you saying that you're opportunistic. And I think we're seeing such a major labor trend right now with contingent workforces, even more so in white collar roles than we've seen. And even at the Motley Fool, a higher interest in contingent workforces. So temporary roles, advisory roles, just not that commitment to full time for every single role for the long term. We want to be more nimble and have the ability to adjust up and down. So it seems to be a major trend in the labor market. So being opportunistic seems like the right call.
It is. And I think that part of what's facilitated that a bit is now with the pandemic, people have gotten used to remote. Here we are sitting on a Zoom call, as an example, right? 20 years ago, it's like, well, are you going to be here? And, we'll get you in our studio. He wouldn't have done this. And so it's the same thing is companies are a lot more confident saying, sure, let me bring in, a marketing expert for 6 months or a year on a contract. And so, yes, I agree. It's the market's a lot different than what it was 20 or 30 years ago.
Can you, Rick, give us a picture of the ideal franchise partner to you, and a leader, and then a second example of somebody you thought or a team you thought would work out really well but didn't, and why?
So, to me, the ideal leader within our industry is somebody who, it's kind of funny. There almost isn't one, because the one thing I'll tell you what the ideal is, but I'll just sit there and say, I don't think I've come across 3 of the ideal leaders in 35 years. One is that, because realistically, to create a good staffing or recruiting firm, you need somebody who's business development oriented. And business development oriented people, they can sell, they can sell, ice cream to an Eskimo. They are, everybody's met those people. But mostly, if you know them or if you've ever employed one, what you realize as well is that administratively, they're a nightmare. Usually, they're usually a nightmare. On the other hand, you get the person who lines up, and the staffing industry, you can create a lot, and recruiting is details matter, right? Like if you're looking to say, hey, I'm hiring a controller for $125,000. You want a person who, it's like, and they give you a list of 20 different things that they want. You dang well better, you, the recruiter, need to be listening to those, to what those concerns are. You ain't going to make a placement anyway. And so the problem is that person tends to be the exact same person who couldn't sell a furnace to an Eskimo. So it's like you create this. So it's like you have to really, the most important thing is to have a person who has enough introspection to sit there and say, you know what? I suck at selling. I'm a great administrator. And if you get me that account, I'm going to latch on, and I'm going to recruit like crazy for these people. But I'm smart enough to realize I can't do it, because here's what happens and we have tons of franchisees that are good at one equation, one side of it or the other, and they're fine franchisees, but they're not what they could be, right? The market, they could be triple, a lot of them could be double or triple, because, again, they don't have the person who's out there bringing them in the business, or they're just constantly churning the business. And so it's a rare business person, but it's the ideal one from my perspective that says, yeah, I know where my weaknesses are, and I'll hire for that, and I'll let them flourish. I don't need to stick my thumb over them. And so we have a couple of great franchisees that really do a good, that really find that balance. As far as the ones that are the ones that I would have thought would have been good that maybe aren't, I think that a lot of it comes I want to be careful, because the person might actually end up hearing this and sitting there, and if I become too pointed in the answer, they're going to know who I'm talking about.
You can just dodge it then. Dodge it.
But
media training says answer the question you want to answer.
Yeah, there you go. So I would just say that we've had, and it's really not even just this one person. There are other people that are like it, that they get incredibly fixed on what they're doing, and they just miss opportunities around them, and they'll drive off staff because it's about them and not about their team. I did this. And all of a sudden, then they run off the salesperson who really was the one who was bringing them in, who was really bringing it in. Or they get greedy, and they sit there and say, holy crap, I'm paying this person $250,000 a year. I'm only making 200 myself. And stuff, and it just blows their mind that they have an employee that makes more than what they do. And they just can't, deal with it.
Yeah.
And that's always the worst person because, again, unless you were stupid in how you set up their original compensation formula. But like, if you have a salesperson, you just sit there and say, well, okay, I'll give you 4% of sales, or I'll give you 30% of every placement you make. Can't you be happy with the 70% of the placement that you get? Why do you have to worry whether that person made $500,000? Who cares? Good for you. It means you made way more than that. But again, those are the ones who, and it happens more frequently than what I wish it did.
The psychology of compensation, something we've talked about at The Fool, having been in business for 31 years. I remember at one point walking through some of our team with the scenario of, okay, you both make 200, okay, or one of you makes 270 and the other one makes 210.
Yeah.
And the number of people who will say, I will take 200.
Effectively, they did.
I don't know why they would be getting paid $60K more than me. I was like, but you're making an extra 10. So there, obviously, it's not just straight math in life.
No, it's true. And so, anyway, that's the biggest disappointment, because that's happened in numerous instances. And like I said, then they drive away good people, and then they end up back. They lose what they had. Because these businesses go. Our typical. Like a lot of our franchisees have been around for 20 plus years, but they go in cycles. And the high cycle, beyond the economy, which is a big part of it, but the other part of it is more mundane. It's sort of like, do I have a good business development person at this point, or don't I? And like I said, they end up with deep pockets and alligator arms, and they just don't want to give that money out to the person. They lose them, and then they struggle.
Maybe we can just pip.
One thing before we transition, I just wanted to reflect on this one point before we now move to a little bit more of the environment that you're in now as a business. Is just that reflection that you shared with us, that you talked about franchisers that have been with you, that are there for 20 years. And what you learned was they will not be there if it's company owned. Right?
No, I would love to have, like, let's say, take somebody like Manpower, just sit there and say, okay, how long have your managers been there in each location? Because I guarantee it turned around. Well, to give you an idea, when we merged with Command Center back in 2019 to go public, we had been a private company franchising. We merged into Command Center, which was public, company owned. They didn't have more than, probably, of 66 offices, I don't think they had 5 people that had been there more than a year. And that's not that, that was 2019. That was a pretty tight market, but it just gives you an idea. And it's incredibly hard in a service business to provide continuously good service if you're constantly turning over people.
Yeah. Rick, maybe we can talk a little bit about the market the market conditions when you think about what you are seeing from your franchisees, and also what they are seeing from the demand out there for the staffing solutions that you provide.
So the staffing industry overall has basically been in a mini recession. I'll call it. Basically, that's a wrong word for it, but it's been in a very difficult market for literally since the first quarter of 2023. It's really been a bad market. Now, what I would say, and it's still, at least, here we are sitting on March 3rd or whatever, March 5th, it's not, and there's no like massive change, what I'm saying? There's no groundswell underneath. In fact, I think it just came out. There were like 77,000 jobs last month that were created, which is the worst since, the worst in like 9 months or something like that, which, it's a pretty moribund market that way. But here's where and now you're probably all collectively, you're sitting there thinking, oh, that was a pretty stupid thing for a CEO to say if you're trying to if you're trying to promote your stock. And I'm not trying to promote the stock. I'm just trying to be truthful and sit there and say, listen.
One of the things we probably didn't qualify or express up front is when we make recommendations and invest our real money behind those recommendations, in many cases, we're a minimum 5 years, not as a requirement. But so if it's a lull now, that's we often love the sound of that.
Well,
Tell us more about how hard things are right now.
So here's where I would say the opportunities, let's say the opportunities exist compared to what it was, and part of why we are where we're at. And I had this conversation with and I've brought it up, frankly, even in our earnings calls. So one of the things that I think has affected the staffing industry, now not so much the recruiting is down, and part of that was, I think that, post-pandemic, there was overhiring. Everybody was afraid they couldn't find people, and so they just went out and they probably overhired, and it created an overhang with respect to the recruiting industry, to a lesser extent the staffing industry. But the staffing industry, we were sitting in, even in 2023, we're sitting with 3.7, 3.8% unemployment, and it's like we're struggling with demand, and it's sort of like that just doesn't, that never, for 34 years in the business at that point, that never happened to us, right? You get anything under about 5-6% unemployment, it's like it's great for staffing traditionally. All of a sudden it's like, what the heck happened here? And so one of the things that, and I've talked about this on the earnings call, so this isn't anything particularly new, but if you look at the jobs, basically the jobs reports, there's an establishment survey and there's a household survey. And they started diverging pretty radically. And the most likely difference in that is illegal immigration. And illegal immigration, and if you just put it in perspective, let's just say, look, I don't live in Texas. I don't sit at the border, so I wasn't counting how many people were coming in or whatever, but most credible numbers show at least 8.5 million, people have come in, say it's 10. And the vast majority of them are working legally, or none of them legally, but you got 10 million people. Now, first of all, that represents like 2.5% of the population in the United States. So it's not a small group of people. Not only that, those are the people who directly compete with staffing companies, especially in the industrial side. And so, all of that gap between, the household, and the establishment surveys are pretty much the people who really we're competing with. And that sort of gets explained by sort of like, good grief, why is our demand tepid, even though we got 3.7% unemployment? We should be, and you think about it, pay rates should be going through the roof. Because if you go back to 2018, 2019, pay rates were growing on a real basis. And all of a sudden now they're not, you're just not seeing that. Well, where is it? Well, somebody's got to sop up that 8-10 million, people. Now, is that good for us? Is it bad for us? It's been unambiguously bad for us the past couple of years because we e-verify our workers. Somebody have asked me, it's like, well, why do you do that? It's like, listen, I want to sleep at night and I don't want to ever get taken away in an orange jumpsuit. It's like, we e-verify our workers. If we can't compete legally and properly, we don't belong in business, and we'll sell it and we'll get out, let it to somebody else, let it to somebody else. But now we have a bit of a, obviously with the switchover in administrations, we have a different dynamic that's going on there. Now, is it all show? Is it all show or is it real? If I had a bet red black right now, I'm betting that it's real. And I got a text from one of my franchisees Sunday night. She said, "Oh yeah, I was talking to a friend of mine who's a friend of mine from church, and she said ICE has been out at 2 of our sites this last week, and hauled a few people away and stuff like that." Now, if that continues, that's like unambiguously fabulous for our business, because we have lost, like I said, hundreds of jobs to that. Some markets are really bad, with it. And we can't really compete with that. I mean, we can to a certain extent if the contractor cares about their reputation, stuff like that. Even to give you an example, historically, in fact, it was really one of the biggest breaks I ever received early in my career. My office was in Miami. My first office was in Miami. Hurricane Andrew came through. And it's like I went from employing 60 people to 600 in the space of a week. Actually, it was 750. I mean, I was sending busloads of people to do debris removal. I mean, Hurricane Andrew was a horrible hurricane.
Yeah.
Now I live in St. Petersburg, Florida. We had massive flooding with Helene. We had Milton come through. We hardly got any business from it because basically busloads of people would come in from out of state. Documentation, what I'm saying? It's like, are they documented? It's like, it's not my job to figure it out, but I can pretty much, and take a genius to figure it out. So we got virtually nothing. Whereas historically, that would have been big business for us. Now, like I said, fast forward, what's going to happen? I think it's going to be, I think it's going to be good for us. And I'm not saying that it's all right there right now. It's not. I'm not saying that, but because you still have a lot of people who are here. Second thing is AI, right? What's going to happen with AI and the tariffs? So that's more of a mixed bag. Personally, the one thing that what I'm hopeful of, but the timing matters for a staffing company, dramatically, and I have no control over this. But I'm old enough to remember when Republicans were for free trade, Democrats were for fair trade, which was really pretty much quotas and tariffs. It's totally inverted now in literally just 20 years. If you really go back and you look at your history, George Bush was out, W was out pushing treaties with Panama, Colombia, South Korea, push. All of a sudden, Barack Obama comes in. Well, we need to renegotiate that, and it killed like 3 or 4 of them got killed, which was traditional, which is how it'd gone for 100 years, right? Democrats, pretty not anti-trade, but certainly not pro-free trade. Definitely very interventionist trade restrictions. Now we're in a situation where we have the Republicans are more the quotas and tariffs. But the heart of a typical Democrat probably is still, well, yeah, I'm not really not really pro-free trade either. So what does that say what our country will, could well be like 3-5 years from now? Sort of like even when Donald Trump's out of office, even if, is the next, Democratic president going to really be pro-free trade? I don't know about that, which means you're already seeing it every day. So-and-so is bringing back production to the United States. So-and-so is bringing back production to the United States. And when you look at AI, especially how it enables automation to a far greater degree, it's kind of like, so like if I'm somebody who, if you think about it, where it's like, let's say you're Whirlpool, and it's like, okay, well, yeah, we used to manufacture everything here. Now we don't. I don't even know if there's a single plant. I don't know enough about Whirlpool to answer that question. I don't even know if they make a single appliance in the United States anymore. But obviously, you start thinking to myself, tariffs are likely to get worse. Not, that threat's worse, not better. And now I've got all these AI applications that I can use to, bring my labor costs down from 30% to 15%. Well, what the heck? Do I need the ambiguity of bringing stuff in from Mexico or Malaysia? Or what would you do? You come in and you say, screw it, I'll build it here. Again, unambiguously good for staffing in the long run, but the timing may not work out that way. And there is the downside of AI, to which it could easily take away, especially on the professional side, how much is machine learned programs going to wipe out low-level accountants, a lot of low-level professional jobs are certainly apt to get wiped out. And that's bad for us.
Rick, I'm curious, when we're talking about AI, I'm curious how maybe your franchise owners are using it. It's certainly impacted the talent landscape in general, but you made the important distinction earlier between recruiting and staffing. And on the recruiting side, there's been so many advancements in the skills and openings matching game. Like the algorithms have gotten stronger, the AI is stronger. So on the recruiting and full-time side, that work is being done for us. But I imagine on the staffing side, for some of this unskilled labor, which roughly could be somewhere around maybe 2/3 of your business, those folks don't necessarily have the most robust profiles on LinkedIn to do a lot of this algorithmic matching and AI tools at their disposal to match them to open jobs. So is it disproportionately affecting your business, like these AI tools in the hands of recruiters and talent?
I have to be honest with you, at least at this point, and I'm not like whistling past the graveyard, and you know what I'm saying? I mean, it's improving every week. There are improvements, but I think we're still a long ways off of where an AI tool will be able to replace sort of that emotional connection between a recruiter and the candidate. There are too many things. And I was talking to somebody about this the other day. Like I'm running my little day labor office in Miami in 1991. And I had this guy, employee. Let me tell you what, almost no client would ever take it. It's sort of like, okay, hey, I need to dig a ditch. He'll be he'll kind of be off by himself. It's like, okay, I can send you Willie, But then all of a sudden there's one client who just loved him. Now, there was no rhyme or reason to it. There's no algorithm in my mind that you could ever come up with that would sit there and say, Willie belongs at McNeil Plumbing. You would never in a million years pick it. And I don't know how that's ever really going to pick that up. Because there are people where it's even, you can't put it, I don't think there's just enough information, because AI, at least, and again, for decades, it's not like it can get inside of our heads and really, yes, it tries to predict based on what our output is, but does it really know what you're thinking right now? You might be thinking, this guy's just boring the crap out of me right now. It can't pick that up. I might be able to pick it up based on and I'm not saying you're doing this to me, but like I can pick up certain things that you're doing or not doing. And a skilled recruiter, for example, can pick that up. Now, where AI is being employed and more effectively is obviously you could sit there and put in certain, let's say, keywords, and it might bring in extra associations to certainly take like, okay, we've got 3,000 resumes and let's synthesize it down to 50 or whatever. And again, those things exist. I'm not so certain that they're all that much better than what they were, and now they're a lot more expensive. And so sometime, at least at this point, and again, I'm not saying that it won't get to that point. I do, it will continue to get refined, but what you're always competing against as well is you're still competing against the cost of it, right? Like sometimes there are certain things that it's like, yeah, okay, it probably makes sense, but I was surprised. I think it was in the Wall Street Journal yesterday. It was talking about how I was actually shocked that, for example, that the reduction in fast food workers in California, the unemployment rate went up 0.2%. I'm thinking to myself, shoot, $20 an hour. I'm thinking to myself, holy crap, it had to go up 5%. I'd have thought it had gone way up. Now, maybe they redeployed to other things. That might not be the best barometer of it. My point is that if AI were really, really strong, and I've actually like reviewed some of, let's say, and it could have changed a lot even the last 2 years, but I don't know if you've ever seen it, like to me, it's slick, right? You go where you'll have like a virtual attendant and you go in and like, it can even pick up if like kids are crying in the background. It's so like, hey, do you want ice cream with your, if it's over 80 degrees, it's asking if you want ice cream. If they're crying, it's like, you need some Happy Meals, it'll upsell you automatically. And yet really, most of the times, you're still not dealing with the automated attendant yet. Well, what does it tell you? It tells you the technology is still too expensive, right? And it may not be as good as what it claims to be, or else, frankly, almost every fast food restaurant in California would either, would basically would be employing it, at a far larger state, or they'd have that bakery in the back, or they'd have a bakery in the back to avoid the $20. I'm just saying, it's $20 an hour. So, or $24 an hour.
I mean, for the fun of it, because the next question I'm going to go to is sort of the financial picture of the company. I had a question in around AI. I'd love to hear a follow-up from Jen on it, just a little bit from what you're seeing or what tools we're using. Is there a divergence in your view from Rick's on this or not? I turned this into an interview where now we're looking at Jen. What do you got, Jen?
No, Rick, I find this fascinating as a recruiter by trade, and there's so many tools coming into the space. And, when you're working with people in the job search, for a lot of people, it's one of the most vulnerable positions they can be in. So the human interaction with people matters so much. And I think especially like in the executive search realm, like this, a bot's not going to be doing this work. But there's a spectrum of tools. And so we use tools here at the Motley Fool that will transcribe our interviews for us and send us our notes so we can focus on that human interaction on the call and not be writing down.
And absolutely. And many of our offices are using it. That's a great example of, that's right, flip it on. But of course, then you got privacy issues with certain ones. So it's like, and then and then our people are still reluctant. Now you get into the human emotion to it. But yes, you're absolutely right. It can try. It can still go back and transcribe it. The other part is, and I always thought it was a sort of, if you think about it, and it was from a marketing standpoint, it was pretty brilliant. And this is where, and again, the good news is, let's say from the MRI side, we're doing typically very high-end placements. And, if you go back, it's been a long time since they used to run that campaign, but you had for a while, Merrill Lynch had it where they had this big running of the running of the bulls, but also they realized it's like, well, yeah, if you're investing a fair bit of money, you don't consider yourself just to be part of the herd, and then all of a sudden it's like a breed apart, and because they realize psychologically, I don't want that. Well, it's just sort of the same thing. If somebody's going to pay my franchisee 30 or 50 grand to place a CFO, they don't want they don't want to be told, oh yeah, we're applying all this AI that anybody who's just willing to buy it would have it. What did you really get from it, right? What you really want is a person who sits there and is going to know, even though they're deploying some of those tools that you're talking about, even if it comes down to, like psychological profiling of the person and stuff like that, all that is, a lot of that is, if not AI, it's still very sophisticated, software that's basically medically or clinically, basically proved over years, but somebody's still got to do that, or else people are going to just sit there and say, no, I'm just not going to, what I'm saying? I'll never do it. And listen, somebody comes up with that they can pick up all those human emotions and facial expressions and all that different stuff. That person's going to be like that person will be the wealthiest person in the world.
Yeah, we're focused on, I think what we see is the power of AI in the right hands, and the power of AI when the most well-versed practitioners are building it. There's just such a delta because it's such a hot item on the scene right now. You put AI in the hands of a novice user versus someone who has been practicing in LLMs for the past 5 years, you get different outputs. So we're really focused on pairing that AI technology with domain experts. And so we have a lot of tools that we use. We have a tool that we use on our recruiting team that was developed by one of our AI advisors who's a leader in this space that helps us find really niche talent that I don't think we would be able to find elsewhere. But that human component at the end, so that merging of the domain.
Yeah, and I think so at the top of the funnel, it's really important. It's really helpful. When you're parsing through, 10,000 LinkedIn profiles, and it's like, okay, let's get it down to 100, and even from the 100, it can start synthesizing it down. And you're right, though, too. It's still putting it, not that it's part of this interview, but like, I think that AI, at least for the foreseeable future, is more about helping a skilled person, whether that's a physician, you start thinking of diagnostic tools. It's like, are we at a point even emotionally where, again, it's like you're going to walk into a some room and sit there and have the computer scan you and say, okay, I'm going to give you this, this, and this, and I'm going to cut this off. And you're going to be thinking, every single person is going to sit there and say, no, wait, I want to talk to a real doctor. You know, that's what you want to talk to. And it's sort of the same, you know, it's still the same concept. It'll bring, you know, it'll bring a lot better data to that skilled practitioner to then go from there. But it cuts out huge amounts of, basically background noise and costs to get to that point. And it's incredibly important and effective from that standpoint. It's a big deal.
I want to go to the financials now and play a game if you're willing to play it with us.
Yeah,
if you're able on your device to see this, does it render for you on your device in a way that it's visible enough, or it's coming up as tiny numbers on the page?
No, it's big enough. I'm old, but it's a little bit harder for me.
I'm not sure you're that old, Rick.
If I were a youngster, I could probably
I'm
see it a
right
lot
there
better.
with
Yes,
you.
I
I'm
can
right there.
see
When you said Tom is my barber, I was like, I don't know that you actually want that. So I just wanted to go through the sections of your financial statements, and you could say anything you wanted to about them. As a former CFO yourself, it means we get a little extra insight. And if you don't feel comfortable playing this game for any reason, we'll move to the next game. But when we look at the asset side of the balance sheet, what is something you think an investor should know about or think about?
Well, I think one really important part is obviously accounts receivable are far and away our largest asset category, and always have been. Good news for that is when you get a let's say a truly difficult economy, you get a working capital release, and so basically leverage goes down significantly. But it's a very fast. We're not locked into big long-term assets like buildings and things like that, which is great.
Let's go to the liabilities. Oh, you want to go to something else? Go ahead.
Yeah, no, and then we have for us, you can go down to the liabilities, but we have a very low, a very, very limited leverage. And really for most of the company's existence, we had no leverage. Obviously, due to the acquisitions that we did, we had a little bit on our line of credit in September. Now, one of the things that I would also say is when you look at that balance sheet, if you were to go back and look at the September 30th of 2019, so which was our first 10K or 10Q after we went public, is you would look at it, and with the exception of there's more accounts receivable and there's more goodwill and there's a lot more retained earnings, you would sit there and say, holy smokes, they've made all these acquisitions over the last 5 years, and yet
leverage.
They basically have a very clean balance sheet, particularly given that we've made like 12 acquisitions over the last 5 years, several of them, really significant, and they were all in cash, and there's no, then none of them were done for stock. And so we had all of that growth, and yet we were essentially able to internally finance it, so fundamentally from an investment standpoint, that to me is the key aspect of it, is that our cash flow alone allows us to continue to grow through acquisition. Obviously, look, we try to grow organically as much as we can, but the numbers are so compelling from an inorganic standpoint that we are very we are very aggressive in acquiring companies. And this is sort of the reason why. Like I said, you look at our line of credit, it's very similar to what it was in September of 2019.
We'll now go to the income statement, so I don't want to linger too much on this, but I just want to at least observe in this world that we live in that if you didn't have the large ownership stake you do have of the business, and of course a number of things would have to happen to cause this to occur, but imagine a private equity firm coming in and saying, oh, no, we can make acquisitions much more quickly than this when we start using debt and stock. Why would we go so slowly?
Yeah, I mean, look, there's two things that even before we went public, to be honest with you, and PE firms provide a valuable service to the economy, and they do what they do. There's
That
no
being
way
said,
we looked first about it, and it's like there's no way we're doing it, for two reasons really. One is, the other thing is our business is built for the long term. We could squeeze out more profits by basically screwing our franchisees, because if you're looking at only a 3 or 4 year time horizon, doesn't matter if you piss them off, because it's like, well, yeah, they're still locked in for another 5 years on their franchise agreement. I can do whatever I want to do. I can start charging them for all kinds of crap that we don't charge for. That's not what we're trying to do. Again, I go back to our fundamental proposition is that we want to be providing value to our franchisees, so we have longevity, with them, and the turnover matters to it. So, and it's the same thing. We could grow a lot faster, but it's a nice story to be able to just continue. Yet we're still, if you look at our actual growth as a percentage, we're like the fastest growing staffing company in the country for the last 5 years.
what do we see here on the income statement that stands out for you?
Well, what stands out isn't what I like to see stand out is that we impaired the MRI office, the MRI acquisition. You see a $6 million impairment, non-cash, of course, but at one point we laid cash out for it. So you still don't like to see it. We're still making money on it. It's one of those crazy kind of accounting things where, the principle's fairly black and white. Is if your business goes down, it doesn't matter if you're doing well. It just matters that you're not doing as well as what you were, and so you do an impairment. So anyway, we took the impairment, but I think the bigger issue is really with the most important part is our adjusted EBITDA, and our adjusted EBITDA has been. And again, this is a tough look at any one of our competitors. It's not an easy environment, and yet we're still throwing off $3.5-4 million a quarter in adjusted EBITDA, and I think that's the most important part of it. Which, I think that's ultimately the most important part about it, and it's very consistent.
Let's go to the cash flow statement, and then we'll go back to Andy for the next question. What stands out for you here, Rick?
So, again, it's a bit counterintuitive. The one thing that I'm not crazy about with, let's say, with traditional cash flow statements is simply they always look bad when we're actually doing really well, because when we're doing really well, our balance sheet expands and it looks like we're bleeding cash. Well, in reality, we're just building up accounts receivable. And so in that respect, it's a little bit, it makes it look a little worse than what it really is. But I mean, fundamentally, when you throw on the amortization we have, and then what doesn't even we also have like notes that we're collecting and stuff, our cash, but that doesn't even show up in our adjusted EBITDA. We have a really strong, and again, almost every quarter, it's still very similar. And so that's one of those things as well, is that it's kind of funny that the staffing industry isn't necessarily it certainly is a bit of a volatile industry, but the fact that we're a franchisor dramatically smooths it out.
Mm-hmm.
And, it because even in the midst of the pandemic, we continue to make money.
Yeah, I mean, I'm seeing here, or I'm keying in on cash provided by operating activities, continuing operations.
Right,
here.
And it's just very consistent. And so, even if we go down, the beauty of it all is that even if our business, let's say like during the pandemic, went down 40%, well, we cut about a third of our staff, because we didn't have near the business, obviously, to do it.
Mm-hmm.
But we were still able to remain cash flow positive. If we had a lot of fixed assets, we could have just never have done that.
Mm-hmm. Thank you for that, Andy.
Rick, talk a little bit about your leadership principles. Just curious, how often are you on the road visiting the franchisees? Who maybe some inspirations when it comes to thinking about leading a $200 million company that you hope to be much larger in the future?
Well, we're not 200 million. We're underlying. We're like 550. We're like 550 million. So, we're a bit bigger than that. As far as, so there were a few parts to that. So what I would say, as far as, leadership principles, I have three. There are 3 or 4 things that, to me, I try to sort of really live by. One is that, like, I'm a big believer, and not from just a trite, I mean, I truly try to live it, is to create win-win situations. I believe our whole business model is a win-win. We provide services at a cost that our franchisees almost certainly could not do for the same thing. So it's like, yes, even though we make nice money, it's not like they could go and replace it for that. In particular, because, like, for example, like, we provide, through our national accounts program, we provide like 17% of the sales to our network. I mean, they just couldn't, they just couldn't easily do it. And that's an important, that's an important part, but we don't, but we're built for the long term. Again, we could squeeze out, there's a lot of things. We could goose our earnings significantly. We could charge an IT charge and just sit there and say, you know what, it's $500 a month. Boom. But you can't imagine how much of, but then you'd start, every time you have a renewal, then you would be fighting with people. And it's like, are you providing that value? And so that's one thing. Number 2, and this is more of just a pure leadership principle. It's like, everybody's replaceable. Nobody, this is all, this is really all teamwork. We have a lot of really good people at our headquarters and our management staff. We got some great franchisees as well. And, no one's out there sitting there, making, HireQuest isn't about me. HireQuest isn't about, our general counsel. It's not, it's really about, it literally is about all of our team. And even within our, within our owner, our management team, for example, there's no politics. It's one of the most beautiful things, is nobody's trying to climb over the back of somebody else and stuff like that, because frankly, they'd be fired if they tried to. It's just not what we do. It's not who we are. We really, which gets back to the final point, which I've already said before, is we truly want to be providing value. And we've got to keep ourselves in that situation where we're providing value, not, well, you're stuck with your contract, and so we're going to stick it to you whichever way we can legally because of this contract. It's like, no, that doesn't do us any good, which is why, like, all of our contracts, for example, they've got buyouts. If somebody really wants to get out, you can buy out. It's basically, it's like 3 years royalties and you're gone. Go. I don't want somebody in the system who doesn't want to be there. Which I think is the other part. It's like, okay, am I on the road? Yeah. In fact, I'm leaving Friday. We're going to Las Vegas. We've got a top performers, sort of incentive trip. And then we've got sales training the week after, and I'm going to be there because it's, it's important. I've been married for almost 40 years. And part of it is I try to keep my travel down as much as I can, because my wife would tell you that I'm traveling every week. I'm saying, no, I don't. I'm not. But, but it's important. We have conferences and things like that. And because that's the other part is that, a lot of my very best friends are franchisees. They're, it's all about relationships as well, because look, we're going to do boneheaded things sometimes, and they're going to do boneheaded things. But if you've got that real relationship, again, it's not, nope, this is what the document says. This is what it's like, that's not, then it's all just transactional. And I'm not saying that's always easy to create or to maintain, but I can assure you, everybody in our senior management team absolutely believes it and feels it, because if they didn't, they'd be gone.
Right.
Rick, just to piggyback on Andy's question, and you referred to, always looking for those win-win scenarios. You had an interview recently, this past December. You were asked about the 3 traits that were most instrumental to your success. You said humility, adaptability, and decisiveness. I want to talk to you about decisiveness. What was the last decision you made that if you would have done a popular poll at the time, maybe everyone wouldn't have said it was a win-win, but you made the decision and we went forward?
Well, keeping in mind, I don't necessarily put decisiveness on the win-win. You know what I'm saying? Like that's not, those aren't necessarily combined. So to clarify, let's say even with decisiveness, I've seen too many organizations, let's say even within my franchise group. Well, let me think about it. And it's sort of like, listen, it doesn't change. The facts aren't changing. You just have to decide, and it might turn out to be a terrible decision. I make all kinds of bad decisions every day. The way I figure it, I mean, honest to goodness, I just figure, if I get 60% of them right, I'm doing pretty well. Nobody has to tell you to breathe, right? It's not really a decision. You're going to breathe or else you're going to die. Well, that's not a decision. But there are other things where you can sit there and, where it's only a decision because it's not obvious what you should do. Sure, after you've done it, then you realize, oh, that would have been obvious. So the thing is, though, is that so many people get hung up trying to do that. So, like, I would say that, like I said, we don't dwell, like we have very limited amounts of meetings. It's just sort of like, the facts are there and it's like, okay, this is what we're going to do. We don't have all kinds of committees and things like that. It's just not how we do it because, it's just not how we do it. Part of it, again, we're nimble to begin, we're nimble, and that's part of how we stay nimble. So the win-wins are more, the win-wins are more about, a franchisee might come to us and sit there and say, well, I want to do this. And it's outside of the something that we can do, but we'll try to do a deal with them that at least is a workaround that gets to the principle, underlying what they're going for. Same thing in acquisitions and things like that. It's like, yeah, it's not exactly what we want, but we might do a deal where it's like, well, yeah, we'll buy it, but we need your person to do this for us. You know what I'm saying? So it's sort of like, and we're always looking for things like that. And so sometimes it drives the accountants crazy because we're like, we're doing like a lot of these little one-off things. But to me, it's more important because then it says to our franchisee or even a potential acquisition, it's like, look, we're trying to we're hearing what you're saying. We're going to try to accommodate it, versus there are all sorts of people out there that are like, well, no, that's not what, that's not what we do. That's not what we do. That's not what we do. Well, maybe it is what you should do, or it's, maybe it's what you should do, because what you demonstrate then is I value you and your thought process. Now, I may not be able to accommodate you enough to make it work, but I'm going to at least try. So it doesn't really fit in the decisiveness, other than to sit there and say, well, yeah, that's all we can do. And it's sort of like, sorry, can't get past that.
Well, and I think we see a lack of decisiveness if there isn't a win-win. Like if it's not going to be a clear win for everyone and everyone's not going to be happy, there you can avoid the decision that needs to be made or make the decision you just said. So,
well, isn't it true though? Human nature, with at least what I've seen, most people, is sort of like, let's say you're just given an opportunity, you're given a choice, and you don't like either. You don't like either of your options. A lot of people, I'd say the majority of people, would just as soon ignore it. And then something happens to where all of a sudden it's like you're locked into one of the two simply because you didn't make a choice. So it's like, okay, well, now you're stuck with it. But that's not a way of running it. You really can't run a business that way. Because in the meantime, because part of it is what happens is then too, it's like, well, now you pissed off a bunch of people in the meantime because they were expecting you to lead and make the decision. And at least then you can go back and sit there and say, well, yeah, it turned out to be the worst of the two decisions, but, options, but we did it because of this, and this. This happened that we didn't foresee. How do we avoid that, that unknown? How do we know, how do we get to that point? And you improve, and hopefully you don't make the same bad decision in the future, but at least everybody around you knows you're that you're leading. You're not just, I mean, because,
There's a shot clock. There's a
Yeah,
shot
they're
clock in
really
basketball for a reason.
That's a great analogy. That's right. I mean, that's a great metaphor for it. I mean,
I remember growing up, we loved college basketball in our family, watching North Carolina play Virginia in a game where Dean Smith, the coach of North Carolina, just realized his team was not as talented as Virginia and just ran the clock out for the half, each half. I mean, I'm making it up, but the final score was like 7-4 or something, or 19-11, because there was no shot clock at that point, and it was better to not have to make decisions when you were unlikely to come up with an outcome from your decision that was going to be above average against the opponent. But that's not a great game, and it doesn't really work in most situations.
No,
My final
go
ahead.
No, go ahead. I'm sorry.
I was going to say our final question, because we want to respect your time, and we've so enjoyed this conversation, Rick. I mean, really, I've learned so much, and thank you so much for being so generous with your time and your insights. I'd like to hear about your leadership style within a public company versus the private company. One of the things that we look for in our Hidden Gems investment approach that caused me to recommend your company for investment and to put real money behind it at the Motley Fool is that I love to find leaders that have the true passion of an owner. I don't have to look for that with you, because you are an owner with the true passion of an owner. And, some of the context on that for some other CEOs in the public markets that I see, Jim Sinegal at Costco wrote into the bylaws of his company that you may not be CEO beyond the age of 65 at Costco. And he told me that was one of the most regrettable decisions he made, because at age 65, he was more excited than ever. He felt really healthy. And so he had to, change his life for that. That's the sort of leader that we're looking for, because as a long-term investor, we know we're going to get to see this person playing the game, the game of bridge of their business over and over and over, and they're likely to get better with each hand. And sure, they'll make mistakes, but they'll correct those mistakes, learn from them, and we get the benefit of that over long periods of time. So how did that change for you when you were running HireQuest as a private company and then going public in 2019?
That's a good question. So obviously, I have a bit of an advantage because I own such a big chunk of the stock. I have more, I have more influence than what I would if I didn't own it. So it's just by the nature of things. I mean, it is what it is. It's a double-edged sword, because if you're an investor, you sit there and say, boy, this guy is really kind of important. Is kind of important to, he's got maybe a little too much control. Then it sits there and say, but who would you rather have control of it than somebody who's been doing it for 35 years? It's kind of like, it just happens to, it happens to help that way. But I would say
let me say one thing about that as you're adding. I mean, it happens to play out that way, but it was intentional. In other words, you cared.
Yeah,
I met an angel investor in Silicon Valley who had very behind the scenes. His name's really not on the internet. He's one of the most successful angel investors. And I asked him, what is your criteria for these amazing investments? Because he's getting early stage of some great, unbelievable success stories in technology. And I said, what are your criteria? And he gave me 5 criteria. And he said, but one of these, I'm going to give you 5, but one of them is worth more than the other 4 combined. And so then he had the whole table at dinner guess what that one would be before he disclosed them. And I was like, well, you believe in them or you trust them. And he said, you can get that wrong early on. And you could trust a very incompetent person, or you can trust somebody who's going to be mediocre. And you could misread somebody's personality who's actually just an outlier and really blasts off, and the business ends up succeeding. And you may not feel full trust all the time for them, but they may actually end up being incredible. So that isn't it. He went to each person and he said, no. Here's my factor that matters more than anything else. When they tell me the terms that they'd like for investment, if they use a round number, I leave. Because anyone that says, I'll sell you 10 to 20% for 4 million, I'm like, they would have that range of equity ownership of the future of that business, that it would be between 10 and 20 for 4 million. I'm out. I want the person who's like, I'll give you 2.063% equity for $1.84 million. And he said, obviously, it's not that extreme to multiple decimal points. But whenever I hear lackadaisical treatment of equity, I'm about to be an equity owner. I want you to take care of my equity. So while you say it sort of has played out that way for you at HireQuest, obviously, that was part of your working methodology as you built the business.
No, I would say though, in going back to your original question, like what is kind of, what has changed, let's say from being, purely private. And so in some respects, what it's really done, and it has been a good thing for the company insofar as obviously the accounting systems have to be, the audit level is, quantum, quantum more difficult than, let's say, back when we were, a private company. We still always had audited financials. So, I mean, there's a lot of extra work in that. I have to be a bit more careful in what, there were maybe things when we were purely private, I would maybe express political preferences or something at that point. Now I don't, it's like, I'm agnostic about it now because, it's not just my company at this point. So it's like, it's not my position to play around with, I'm saying we're not a political platform. We're a staffing company. And so, and those are good things because it sort of enforces a certain amount of discipline in what we do that we might not have otherwise done. And yet culturally, it's so ingrained in our company that we're not committee run though either. I mean, I've seen it with too many, even with opportunities when we might be trying to cooperate with a fellow public company. And it's like, well, it's got to go to here, and then it's got to go to here, and it's got to go to there. And it's kind of like, well, for crying out loud, by the time you get through all of that, the opportunity's gone. Just forget it. Don't worry about it. And so many opportunities. And again, that's where it goes to that, that adaptability that I was even talking about back in the December thing otherwise. And it's kind of like, again, it's like, well, no, our parameters aren't that. So I think we've got a good mix of it, and we probably have more structure around our decision. Not probably. I know we have a bit more structure around our decisions than maybe what we did. And now maybe that's part of my, just getting older, but it's sort of like it, intentionally developing the part of it, which is a lot larger, is that sort of the next level of management for them to make important decisions, whereas 7 years ago I would have made them myself. I don't, they know what they are, and I trust the decisions that they generally, that they make. Although fundamentally it all still goes back to it's like, if our franchisees do well, we do well. If our franchisees do poorly, we do poorly. And it's just that simple. So it's like, act in accordance with that, and good things will happen. And
Hermanns, thank you very much for your time. You've given us a lot to think about with HireQuest. I'm so happy that we've recommended the stock and invested in it. And I'm looking forward to following along. And for Andy Cross and Jen Elliott, we thank you for the extra time as well, and look forward to having conversations again in the future.
You're welcome, and thanks for being a shareholder.
Thanks, Rick.
Good afternoon, Asit.
Hey, Brian, how are you?
Good. Welcome
Great to see you
another.
again.
Yeah, it was a good interview. At least I watched the last part of it.
I only got to see the last few minutes, but I'm going to find some time to learn more about HireQuest for sure. So we've got a shortened hour, 45 minutes. And again, today we're talking valuation. Brian, we had great sort of generalized conversation about valuation. I was picking your brain about the pharmaceutical and biopharmaceutical industries. And I thought as people are getting questions into the queue after this recorded interview, we could sort of continue that a little bit, if you don't mind. And the question that we left off with yesterday, or the idea is clinical trials. I wondered if you could unravel some of the mysteries behind the strategies that companies take when they develop their clinical trials, because you alluded to this a little bit. That, and let me give you my uninformed take on this. It seems to me, and maybe this is a good way for us to begin this conversation, is it seems to me that oftentimes when companies are putting promising candidates through clinical trials, they're not quite sure which ultimate path they'll take towards commercialization or which use case will be the final use case for the drug. So if that uncertainty does indeed exist, let's say you've isolated some kind of compounds, and you can probably make this illustrative much better than I can, how do you begin to strategize from taking what could be a generalized therapeutic application and thinking through to the commercialization phase? And how's that reflected in the way companies approach the clinical trials that they develop? Because it's not just about the science, right? It's also about communicating with investors as you go along, trying to understand what you can generate in revenue from those therapies. So I was wondering if you could talk a little bit about this.
Yeah, I mean, so there's a lot of drugs that can treat more than one disease, right? I mean, I think that's what you're getting at here, right?
Right.
And so, how do you pick what disease to go after? And I think there's maybe maybe three major strategies. One is just go after the biggest indication, right? And that can work, but a lot of times there may be competition in that big, large indication. In which case, maybe that's not necessarily the best path forward. Another option is the quickest indication, which would be the one that where it's the most severe disease, so therefore the clinical you can read out the result of the clinical trial as quickly as possible, right? So let's say a fourth line lung cancer patient has a survival of a first line lung cancer patient has a survival of a year or more, right? So obviously you can read survivability a lot quicker in the fourth line, and therefore you can get approval quicker because you can run the clinical trial quicker. Now there may be less patients there, but also and then the other thing with speed is how quickly can you show a difference between the drug and the placebo, right? So the bigger that difference is, the less patients you have to enroll in the clinical trial, because statistical significance is determined by the number of events and the distance, right? So if I flip a coin 10 times and there's 6 heads and 4 tails, you're going to say that's not statistically significant, right? That's just, it could have been 5, it could have been 6 the other way. It's, who knows, right? If I do 100 and it's 60 and 40, well, now you're thinking, well, maybe this is a rigged coin. If I do 10,000 and there's 6,000 heads and 4,000 tails, now you're thinking this is probably not rigged, right? So that's the same thing with clinical trials, right? So if the measurement is large, then you can have a smaller number of patients. So like if I had a 10, if we go back to the 10 and it's 1 and 9, you're probably thinking it's, and if I go to 100 and it's 10 and 90, you're definitely thinking it's rigged, right? So
Right.
where when we did 6 and 4, you didn't think it was rigged at 100, but at 10 and 90, you're convinced it's probably rigged, right? So that's the same thing with clinical trials. The bigger the distance between the drug and the placebo, the fewer patients you need to be convinced that difference is that difference is statistically significant and therefore likely to be real. So
let me interrupt here and just get a question of clarification for those of us like myself who don't understand how these trials work. So before you actually have the formal clinical trial, you already have some indication of the efficacy versus a placebo. How do the scientists derive this? I mean, how did they know how many patients to enroll in the trial? That's something I dismissed as you were talking.
That's the thing. So usually you're basing it on the phase 2 clinical trial data to determine the likelihood of statistical significance to the phase 3. And they do. Now we're getting beyond my knowledge of statistics, but there's something called power. And so, generally they want a 90% power. So now it's like there's a variability within that. We could go higher than that. We could go lower than that difference from the phase 2, and so we want a 90% most biotechs will design their clinical trials so they have a 90% chance of detecting if the difference is the same between the phase 2 and the phase 3. There's a 90% chance that they'll be able to detect that difference, and it'll be statistically significant. So that's usually where, and then you can go bigger, or you can go smaller if you want to gamble one where, if you want to hedge your bet or gamble, so there's that too. And a lot of times I don't know, it can be a little challenging. Some companies are a little more forthcoming with their thought process on the clinical trial and whether they think it'll be statistically significant or not. But generally, the phase 2 clinical trial is usually, but not always, statistically significant, right? So in the phase 2, you've already got enough patients to be, to show the difference, and now you're just increasing the number to get a better readout of the efficacy, because with the smaller number, it's, there's probably more variability in the potential likelihood of success, right? And so but sometimes phase 2 aren't statistically significant, but there's a difference enough that the companies feel confident, and those are the ones that maybe where the phase 3 is a little bit less, investors should have less confidence that the phase 3 is going to be successful if the phase 2 isn't, hasn't been statistically significant, but there was a difference. So yeah. And so then to go back to your, I guess, original question, which was, how do you figure out what to do with your what disease do you go after? Another option is to go after a small indication that has an unmet need. So in a lot of, a rare disease or something where there's no competition, and if you can show a big difference, oftentimes you can show a big difference in those diseases, because there's no, the patients aren't being treated with anything else. So they're either really sick, or if you can show that they can get it better, then that helps you immediately in terms of that difference. And so therefore you can oftentimes run small clinical trials on rare diseases and still show statistical significance.
Is it a misconception of mine that the FDA looks a little more favorably on sort of these like orphan drug types of trials, and is more willing to give latitude?
Unmet need. So not necessarily the size of the. Sorry, I think are we good? I think I talked over you because you'd stop talking on my side, but I think you were frozen or something.
Yeah, we're having some storms in the area, so I'm hoping that that's not affecting the relay. But now you seem I've got you again. So I apologize. We have the storm front that's been moving through, sort of hitting our area, but it looks like we're good for now.
Yeah.
So just going back then to these 3 major lines of attack. So we talked about going for the biggest disease state that's out there, then quickness is another strategy that you can use, and then aiming at unmet need. I was curious about 2 more things, and then maybe we can get to Slido. So the first of those is, do you ever see narratives shift by management teams? So obviously in the non-pharmaceutical arena, we see this all the time. Something that's a promising innovation, let's say in the semiconductor industry, is brought forth to investors by management. Then after some time, they stop talking about it, or they make some subtle changes. Does this go on in this industry, Brian, as you see, where those management teams that are more forthcoming about their ideas and the rationale for their design of clinical trials, do those narratives ever shift where suddenly they're saying, actually, this is only one of the use cases that we were pursuing. Now if you look at our latest, let's say, investor presentations, where we have those great charts of pipeline drugs, we also have these states we're exploring.
Yeah, I mean, I think it depends a lot on the amount of capital that the companies have, right? So oftentimes they'll go after 2 or 3 in the phase 2, and then they'll pick the best one to go into phase 3. Or if they have a lot of money, then they might go after multiple ones, multiple indications, multiple different diseases in the phase 3 program, where when currently right now we're a little bit more capital constrained. It's not easy to go out to the secondary markets and raise a lot of money if your valuation is down. And so companies where the valuation is down are picking the best one and going after it. You do occasionally see companies make 180 switches where they're going after one disease, and then they either they get data and then they realize, okay, well, that's not going to we're not going to pursue this anymore. We're going to go after our second best option because our first best option doesn't look like the best option anymore. And so that'll happen sometimes. Sometimes something will open up where they realize that there's a new opportunity, and so then they'll just like I don't know, they have an epiphany or something. It's kind of a little weird in terms of like it's not clear exactly what causes this, but occasionally, especially with small biotechs, you'll see all of a sudden they're like really excited about this new potential. Maybe there's a paper comes out from an academic source that says, oh, the protein that we've been inhibiting is involved in this process for this disease. All of a sudden, like, nobody knew what was caused this disease, and now we know it's this protein overactive. When this protein becomes overactive, we get this disease. And so now they're like, oh, well, we have an inhibitor of that protein, and now it's let's say it's it's a disease where there hasn't been any treatments because we didn't know what was the treatment, and we have the lead drug that attacks that protein. So it's a really no-brainer for us to go after that because it checks off all the boxes, even though we weren't hadn't really thought about it until 5 minutes ago. So and then just to go back to your FDA thing on orphan diseases, I don't think the FDA looks better on orphan diseases. I think the FDA looks better on diseases with unmet needs. So it could be a large, could be a large disease. It can be a small disease. So let's take Alzheimer's disease, for instance. If you had a disease where if you had a drug that clearly was treating Alzheimer's disease in a great way, you could probably get away with with only running one phase 2 clinical trial, even though that's a very large market. Late stage cancers where there's no other options. The patients have taken every other drug, and now we've shown that we can do we can treat those patients and show that we can improve their survival. The amount of time that they're surviving. Those drugs can get approved with just one phase 2 clinical trial. Then they have to go run a phase 3 clinical trial on an earlier stage to gain full approval. But there's this thing called shoot, I just forgot the name. But there's an approval process that is like a temporary approval, and you have to go back and show your full approval before you can. You have to show another a large clinical trial before you can gain full approval.
Wonderful. I appreciate it. So let's do this. I have that one remaining question, and it's related to commercialization, but I'm going to save that for now. That question is related to the nominal theme of this hour, which is valuation, but we're going to save it. We do have some questions now, so we'll work through our questions, and then we can return to this. But I really appreciate that. That's one of the things that I'm interested in this industry, is maybe not so much understanding how to analyze different compounds or therapies, because I'm not a scientist, but to really understand how an investor like you, who has a PhD in this stuff, looks at drug development as a business proposition if you're going to put your capital into it. And the last couple of days it's been really fun to get your insights on this. So we'll move to the queue here. I'm going to grab one. I see some nice questions here. This is actually just a general question from Ed. I'll start with this, and I see a few questions for you already, Brian. Ed says, Asit, which service has the better foundational stocks, Rule Breakers or Stock Advisor? So Ed, I think both have great foundational stocks, and I'm not saying that to be diplomatic at all. I think both services present really high quality ideas. Stock Advisor, as you know, has two sides of our scorecard. We actually have a side of the scorecard called the Rule Breaker side. The other side is called Hidden Gems. And those have different takes on what foundational stocks are. The hidden gem side of the scorecard, of course, looks for companies that are maybe misunderstood by the market. So while they may be companies that are there in plain sight, they could be hiding, meaning the market doesn't understand what the special advantage of that company is over the next 5-year period. For the rule breaker side, obviously, if you've read those write-ups, we have sort of, I would call them loose criteria that we use when we're thinking about stocks before we make a stock recommendation. These are 7 different criteria that have to do with things like the financial position of the company, whether that's scalable or not, how vested the management team is in the business, what the risk profile looks like. Is it, Brian, we were talking about binary risk profiles yesterday. We actually, in Stock Advisor, on that rule breaker side of the scorecard, say, is this a reasonable risk profile or is it binary? It's not that we mind a binary risk profile, but for that service, that's what we gravitate towards, or those that have a more reasonable risk profile. Is the valuation reasonable when you look out 5 years or 7 years or 10 years? These are things that the rule breaker side of the Stock Advisor scorecard thinks about in foundational stocks. And the rule breaker service, of course, is a different service than ours. They may pick stocks with a lower market capitalization than Stock Advisor. We have a sort of a $10 billion floor that we try to institute. We don't always do that. If we see, once in a while a stock that may be $5 or $6 or $7 billion, and we have other convincing reasons to recommend it, we'll do that. But I think really understanding the foundational stocks through the service lens is the best way to make your own judgment on whether the last quarterly update of foundational stocks makes sense to you. It might not. You might think, hey, rule breaker side of Stock Advisor scorecard, you sort of went against your principles here. I don't like this. This doesn't seem very foundational to me. And that's the beauty of being a community. And more than that, Brian, being a community that encourages members to learn for themselves, to think for themselves, to teach us as we go along, to bring us ideas. I think the ability to read a recommendation, whether it's for a monthly recommendation or it's a foundational write-up, and think through that logic, bring some critical thinking skills to bear to it, is a wonderful way to get better as an investor. And I appreciate the question. Okay, so back to you, Brian. Do you want to grab one of these? I see several for you.
Yeah, give me, No Noise asks about thoughts on Vive and Vertex Pharmaceuticals over the next 5 years. So let me pull up since this is the valuation hour, I figured we'd actually do some valuation versus just.
And I'm going to watch with interest and chime in, because speaking of Stock Advisor, these are both recommendations in Stock Advisor. So I happen to know these 2 companies.
Why can't spell revenue growth. There we go. Okay. So my thing is up. All right. So both companies doing quite well over the last, let's say, 5 years. Vertex is obviously doing substantially better. We'll normalize this so you can see. So over the last 5 years, Vertex is up 128%. Viva Systems was doing quite well and then has sort of tailed off a little bit. Let's add the S&P 500 just to give a relative. So the Vertex is beating the S&P 500 over the last 5 years, and Viva is not. And over the last 3 years, Vertex is handily beating it, and Viva Systems is about equal with the S&P 500. So then, just looking at valuation. So here's some valuation metrics that you might look at. I missed price free. Okay, so we had the PE and the, let me go back to unchanged. So you can see the price to free cash flow has come down a little bit, but it's still pretty high at 54. And the PE, I'm sorry, the price to keep free cash flow is here, and the PE is at 54. So a very high priced company over the last 3 years. And then if we look at revenue growth over the last, now we're at 5 years. So you can see the revenue growth has come down, and now the price to sales ratio, the revenue has sort of stabilized a little bit. We have a high quarter and a low quarter, but if you ignore those two, it's been in a pretty tight band around between 10 and 15% growth over the last few years. And the price to sales rate, price to free cash flow, and the price to earnings ratio have been, fairly consistent, obviously with some variability. So my thought here is that if they can continue to grow at 14%, and the price to free cash flow or the price to earnings ratio end up staying the same, even though they look quite high, then you're going to end up getting about a 14% return, somewhere in that range for whatever the growth of the revenue is going to drop down to the bottom line. So I've never owned Viva Systems because it's always been looked very expensive to me. I mean, especially when the PE was up at 120, right? I mean, yes, it was growing at 30%, but I wasn't convinced that was sustainable, and sure enough, it wasn't. And so that valuation has dropped as the revenue has dropped, and that seems completely reasonable and understandable. And now I think we're in a period where they're growing at a normalized clip, more not hyper growth clip, but a nice solid growth. And they've been able to grow they've been able to keep, the investors have kept the price, the valuation net multiples about the same. And so I think that, maybe you can buy a little bit on a dip on these, on this dip right here might have resulted in you having a slightly better return than if you bought, up here at this high multiple. But, and so you can sort of use these as a valuation metric to figure out when you want to buy. But, I think the main question is, can they continue to grow at this 15% clip, because that would result in you having, probably outsized returns compared to the S&P 500 if you assume it's going to do 12% per year. So I've been shocked by Viva Systems in that I always thought that they were running out of ideas of what products to sell. So this company sells products to pharmaceutical and biotech companies. They started out with a CRM that allowed their sales. So it was only for companies that had drugs on the market. And it was a CRM that allowed them to keep track of the doctors that the Salesforce went out to go look at it. And, it would integrate in prescriptions that the doctor was writing. And so they could figure out whether, is the doctor writing more prescriptions? Should I go try to nudge them to write even more? Or has the doctor stopped prescribing? So, I should go ask them why, is there a new drug out that they think is better, and try to explain why ours is better, and that sort of thing. And then they went into now they have a lot of cloud-based data storage. So one for preclinical work, a lot for clinical work, one's for tracking issue side effects after you have drugs on the market. Pharmaceutical companies are required to, doctors come in and report the drugs, issues with the drugs, and then the pharmaceutical company has to report that to the FDA. So that's, they have a system for that. And so they have all these systems, and, and I think probably every pharmaceutical company actually uses Viva Systems. So I've been, surprised and impressed by the company, for
Brian,
sure, but I've never, go ahead.
Yeah, so I want to please leave this up, but I want to chime in. I think collectively, it's interesting. Many of those services that you mentioned are nestled under something called Vault. So that's just the name catch-all for their system. But that's not a bad name if you're talking to pharmaceutical companies, because the idea is, right, have data in a secure place. And then it's a really good question that you asked. Like, maybe this company is going to run out of ideas. If we go back in time 3 years ago, it's about 2 or 3 years ago where they announced they were going to sort of split from a relationship they had with Salesforce.com. That was really the engine of their business, which helped companies market their products, and they were going to build their own CRM in the cloud with these other data services. And that migration, I mean, it's not complete, but they've really begun it in earnest in the last year, and they're projected to pull most of their big clients over. But I do think that they are gaining more business with this array of services. It's interesting. We were a little bit skeptical of the company's ability to show that it was relevant in maybe a generative AI first world. About a year and a half ago, Peter Gardner, the CEO, was asked on some calls and really had not much to say. But in short order, they've been able to use generative AI in a way that makes sense for them and makes sense for their customers. So they have one sort of chatbot that helps with compliance, I think, in packaging. And that's a real specific use case. It's not some kind of flashy, oh, we're using AI like everyone else. It's something that makes sense to a customer. And I really like the way you've set this up, because the question is, like, can this company continue to grow, let's say mid-teens or above? It used to be a 20% grower earlier in the chart, even before the pandemic. I think it was a company that had sort of some of this space to itself. Now there is a little bit of competition, and Salesforce.com, with at least one customer that hasn't migrated, has, I think, pulled back one like top 20 pharma. That, just reading between the leaves on their last call, you can take that for what it's worth. But the valuation, and let's call this relative valuation, it looks interesting here. I was just looking at some numbers on a forward basis. The free cash flow per share is, this company trades around 31 times next 12 months free cash flow per share, and the forward PE ratio is not too different from the free cash flow to shares. So looking for more earnings on a forward basis than this trailing basis, you get that, let's say, in the mid 30s, and they can sustain a mid-teens growth rate. To me, that seems like not a bad proposition. And if the market sells off a bit, it could provide an entry point for those who are interested in the company and its advantages. That migration to Vault isn't a done deal, but I mean, to us in Stock Advisor, it looks like they'll pull most of their customers over. The initial sort of migrations they've been reporting on it have been pretty favorable.
Yeah, and then so I guess we could just yeah. So I mean, I agree with you there. And then if we just want to look at Vertex really quickly,
Vertex, yeah.
I think Vertex, I would say, is probably overvalued at this point. So here's and then maybe we can do price to sales in here too, because price to sales tends to be better for pharmaceutical companies, because then you don't have to worry about the noise of the thing. So revenue has come down substantially as they're sort of maxing out the number of there's only a limited number of cystic fibrosis patients. So they're basically getting to the point where they're almost treating every cystic fibrosis patient, and they're getting into here where they're getting small gains from the fact that maybe they get it initially approved for adults, and then they get it approved for children, and then they get it approved for infants and toddlers, and so then there's these small gains here, and maybe they get it approved for the EU or for the US,
right?
And then they get it approved for the EU, and so now they're getting it approved for even smaller countries, and so those are creating small gains, but the value has gone up substantially, especially in the last few years, and that's mostly due to the fact that let's go 3 year. There's high hopes for the for the pain drug that they've just launched, and so the hope is that that this sales can ramp up. They haven't given any guidance on where they think the pain, how much they're going to be able to sell of the pain drug in the first, quarter, 2 quarters, 3 quarters. And so it's hard to tell, but I feel like this is a pretty high valuation for, if we look at the max or 10-year chart. Well, that didn't really work. So there's obviously it's been much higher in previous iterations of the company as they were launching drugs. But if we even just look at the last 5 years since they've already had multiple cystic fibrosis drugs on the market. So there was obviously a launch of a cystic fibrosis drug here. So there was expected revenue coming in, and then even though the revenue has gone down, from let's say here. The revenue was in this range and it's gone down to this range, but the PE has gone and price to free cash flow have gone up. So I'm not sure that this is the best time to be buying Vertex Pharmaceuticals. I'm a shareholder. I'm not selling my shares, but I'm not convinced that this is the best time to be buying either.
Yeah, and I'll just add to that. I think that what we see in the valuation now around Vertex is like a confidence level. You said hopes, Brian, for the pain medication. I think they're sort of the same thing. I think the market was very skeptical a few years ago that Vertex would be able to develop drugs outside of the cystic fibrosis like complex to replace those cash flows when the patent protections expire. And it's still a long ways away. I think it's like 2033. But the company is a really broad pipeline, and none of it's easy. This is a company that chases some pretty hard stuff. But I think that approval of the non-opioid pain medication, plus some shifting of things into like phase 2 within their pipeline. They've got a lot going on. The beta thalassemia drugs they've got. I pulled it up while you were talking. Yeah, kidney disease is still one that they're working on.
A couple years away. I mean, they just started the phase 3 clinical trial, so it's a couple years away, but that's a big opportunity for sure.
The APOL1, right? That's the one that we've been focusing on in Stock Advisor. It's in phase 3. Yeah, so I think the market just feels a little more confident that they'll be able to execute. And this goes back to that original question I have. It'll have to maybe, I think I'm signed up with you at least 1 or 2 more times in the next month or two. This will have to wait. But the idea of commercialization, when you look at a company, do you look at the management team's ability to bring a drug successfully through research all the way into a commercialized state? And I think it's important. I think, especially with smaller businesses, to know where the scientists come from, if they've got experience in commercialization, who they've hired, can make some difference. And especially when you get this stage where you've got a company that's already successful, has very stable cash flows, but it needs to grow and it needs to replace revenue in the coming years. I think this team is very strong here, but it's gotten a little pricey for sure. Okay, so Brian, I tell you what we're going to do, if this is okay with you. We've got lots of questions directed for you, so I'm going to maybe just ask, and I might combine a few of these on behalf of our viewers. There's one that Besties has asked in 2 different ways, but it's about that really robust supply chain that the Chinese have developed over the years. It used to be that Chinese labs were used for CRO organizations would use Chinese labs for clinical trials, and then all kinds of stuff are outsourced to smaller Chinese firms by big pharma. There's some thought that now the Chinese are just getting really good at doing the science themselves, and they already have all this infrastructure. So maybe we'll combine Bestie's 2 questions. Bestie says, look, Chinese pharma companies must have the best valuation considering their API supply chain and innovations, and the regular investors either ignoring those companies or just discounting them, because we know the Chinese market is difficult to invest in. It often has the specter of regulatory oversight from the Chinese government for whatever reason coming in, and we've seen that in other industries in China. What are your thoughts on investing in Chinese pharmaceuticals, and are there any opportunities that you happen to like?
Yeah, I mean, I would personally stay away from any small biotechs that are in China, just because I mean, there's different regulations in terms of, disclosures and that sort of thing. And I wouldn't feel confident in in investing in small biotechs. I think Beijing, BEIGNE, has become a new, has become a large biotech and has multiple drugs in the market in multiple regions of the world, not just China. And I think they've separated themselves from China. They're changing their name to one something. They've already changed their ticker, and they no longer call. They used to, in the press release, the first thing in the press release is where the press release is coming from, right? And so it used to come from Beijing, right? Beijing, the capital of China, and now it comes from the city in the Bay Area, San Francisco Bay Area. So they're clearly trying to separate themselves from China. So I think that should tell you everything you need to know about whether you should be investing in Chinese biotechs. If the largest of the Chinese biotechs is trying to separate themselves from being a Chinese biotech so much as that they change their name and change their headquartered location. So I wrote an article for a non-Fool publication, and I put Beijing as their headquarters, and they would say, no, we're a multinational company. Like their PR people wrote back to me and said, we're a multinational company. So we ended up having to write, the Beijing of, and then four different cities, because they're trying to, that was right before they changed their name, and then they changed their name, and I was like, oh, now I understand why they're trying to do that. So so I think the other major company in China that might be investable is Wuxi, WUXI. That's a CRO. They do a lot of mostly, preclinical work for small biotechs. And the question is, is the government ever going to, make it so that that they can't do that work, especially beyond the preclinical. They also do a lot of manufacturing. And so I think the bigger question is, is the U.S. government, if there's a trade war or whatever, is the U.S. government going to start trying to crack down on manufacturing of drugs in China? And if that's the case, I would think that would hurt Wuxi. I mean, there was a big talk in the last administration about that, and nothing came of it. So I just, I'm not a political science major, so I just don't know how to confidently handicap that. So in my, my thought is just stay away and don't invest. But I think if somebody's feels more confident, there may be an opportunity there to buy something on sale that could eventually have a multi-bagger in the or handily beat the S&P 500 over the next 5 years if nothing comes to fruition, because I think there's probably still some underlying issues that there's some underlying risk that investors are putting into the valuation for Wuxi.
So Brian, I'm going to tackle a non-pharmaceutical question and give you a chance to look over the queue and see which one you want to take next. No Noise asks, please rank Grab Holdings, Dash, DoorDash, and Mercado Libre over the next 5 years. And I think the answer to this question depends on what you're looking for out of these companies. If you're looking for growth from a very sort of stable base of business, DoorDash might be the first among these companies. It has both an attractive free cash generation profile over the next few years, and also enjoys sort of market dominance with just a few other companies. Personally, I think the time to build a company that competes with the likes of DoorDash and Uber Eats has passed. There was a lot of capital directed towards that during the pandemic, and now it's almost like a high barrier to entry industry, very hard to do. DoorDash spends a lot of money on great tech, and so the logistics of getting into an area, becoming very dense in that area, they're sort of masters at that, and they took a lot of learnings from the acquisition of Flink over in Europe a few years ago, just lifted and shifted a lot of that technology and know-how. And so I think they're very formidable in this delivery space, and also are successfully branching out into retail deliveries. You're going up against companies like Shipt. So just a very solid company there, a nice balance sheet. Mercado Libre is always interesting. It's a very solid company in many ways, very highly ranked in conviction across different full services. I personally feel a little more cautious on Mercado Libre because the nature of that business has shifted over the past several quarters. They're getting much more of their revenue growth and like bottom line expansion through finance income. So becoming a lender, getting into the credit card business. There's a easy come back to what I'm saying in that if you were Mercado Libre, you would be doing that too. If you were the first mover and sort of dominant brand in that space in Latin America, you would also be trying to get a lock on so many unbanked customers becoming banked customers, then banked customers starting to use credit and being sort of a first lender of choice to many small businesses that operate online. So not dinging Mercado Libre, just saying to me, though it's a great growth story and still has growth ahead of it, it has a higher risk profile than it did even a couple of years ago. And then Grab Holdings is a great little company in South Asia. This is actually on the Stock Advisor scorecard as well. All three of these are. That's a company that has a lock on a very difficult geography. So many of its delivery people operate in places like Vietnam, where you have to really understand how to get around on a motorcycle in dense geographies. Well-run company, has been trying to expand a little bit outside of its core markets like Vietnam and Malaysia. So that's a longer-term growth story, but has been pretty reasonably valued for a few years. So again, I wouldn't rank these in any kind of order. Just say, hey, this is the best company for the next 5 years out of these. But depending on what your risk profile is and where you're looking in terms of position size for your own portfolio, I think all three can make sense for a lot of investors. And we've got about 3 minutes. So, Brian, I know there were a few more questions for you.
Yeah, I'm going to try to knock off two really
Great.
quickly. So, Danny asks thoughts on biotech ETFs versus individual stocks, and if ETFs, which one's best. So, I used to say that the XBI was sort of the best for tracking small biotechs, but they changed their setup. So instead of being equal weight, now it's weighted by market cap. So basically, buying the XBI, you're buying the top 10 or top 25 or 50% or something of the ETF is based on the largest biotech company. So you're just basically buying the largest biotech company. So it doesn't make sense. There are other ones. There's the Life Sciences Biotechnology Clinical Index. Ticker is BBC. It's by VIRTUS. Life Sciences Biotech Clinical Trials. It's got a high expense ratio of 0.79, so I'm not sure it's really the best one to be investing in. But I prefer individual biotechs mostly because there's a lot of crappy biotechs out there, and I think with a minimal skill, you can identify the crappy biotechs and not invest in them. And so just by not doing that, you can beat the biotech ETF by buying a basket of non-crappy biotechs, because the biotech ETFs don't necessarily screen out for any, for crappy biotechs. I'm thinking like a company's phase 2 clinical trial fails and the company doesn't have any other options, so they just go ahead and run the phase 3 clinical trial, right? You're not going to invest in that, but that may be in the biotech ETF. So that, I think that there's no reason to own that company. And I think, most people can realize that that's a bad investment, but if you may be buying that shares in that company if you own the biotech ETF. So I think that's I think that's a challenge that I would stay away from. So, and then there was a question on CRISPR Therapeutics, and I'm going to try to do a 3-for-1 in a minute. So CRISPR Therapeutics is a $3.6 billion market cap. They have one drug on the market and they own 40% of it. Vertex owns the other 40%. I think that's, maybe a high valuation considering all of their other stuff is early stage. Sort of depends on, we don't quite know what the sales are going to be in the long term for that beta thalassemia and sickle cell disease drug. So I think that's, a challenge. There are 2 other CRISPR CRISPR companies, companies developing CRISPR drugs, Intellia and Editas. Editas is like 121 million early stage. I don't. It's a stay away from it until it gets more data. There's no reason to be buying $121 million biotechs that are trading for less than cash. It's clear that it's going to have to spend a lot of cash. You might as well buy it at 2x or 3x that rate, but have a higher confidence that they're going to have something. In between there, Intellia Therapeutics, the ticker is NTLA, is at $946 million market cap. They have 2 phase 3 clinical trials and a phase 2 clinical trial. So potentially more opportunities over the next 5 years for Intellia over CRISPR, but you'd be paying 3.6 or more than 3.6 times as much to buy CRISPR right now than to buy Intellia. So I think of the 3, Intellia actually looks like a better deal on a valuation standpoint from my perspective than CRISPR does.
Wonderful. And Brian, just as we finish up the hour, now it's clear the sun has come out for me. So apologize for those issues at the beginning, and we are probably have left our YouTube